if what the Ways and Means Committee finds offsets in its jurisdiction, such as rolling back the renewable subsidies in the IRA, that could add hundreds of billions and more room to cut taxes. So yes, I would expect no tax on tips be a high priority for the Trump administration. Some SALT relief, you would expect some kind of pro-manufacturing incentive, whether that's the 15% rate for domestic manufacturing or full expensing for structures on certain manufacturing structures, things like that. I think would be the net new tax cuts on top of the existing extensions.
Hey, Don, appreciate it. We've got to leave it there, sir. It's good to see you. Don Schneider there of Piper Sandler. That tax effort, of course, will complement in some way the tariff effort. So let's talk about the tariff effort. This just dropped from Capital Economics, and it echoed some of the words Don used there. If the Trump administration pursues a reciprocal tariff strategy rather than a 10% universal tariff, then it could result in a smaller rise in the overall effective tariff rate than we've assumed. Point one, who's exposed? We've talked about these names, India, Brazil, Turkey too. They go on to say, though, it's probable that their governments, among others, would provide concessions to President Trump in an attempt to prevent reciprocal tariffs from being imposed. Now, India keeps coming up. The fact that Modi is meeting with the president today, and we could see this announced hours before they talk, is kind of amazing.
It shows that this might be the template, as Anne-Marie was talking about, that you say, excuse me, this is how you can appease us. Please cut your tariffs, and then going forward, we're not going to threaten you, and we can work together, and it's good baseline.
It's almost like he's producing a show today. Come out with all the threats. Modi walks into the West Wing. They have this Oval Office meeting. Everyone talks tough. Modi, according to the reporting, is ready to come with these concessions and say, I'll cut my tariffs. Maybe I'm going to buy some more U.S. aircrafts. And then guess what? They're not on the other end of those reciprocal tariffs anymore. Now he's focused on Brazil or the European Union or Turkey.
I'm not going to pretend I know what's going to happen later on this afternoon because I've got no idea. Absolutely no idea.
I'm speculating.
Well, when does the focus start to go to, can the U.S. produce all of the goods that we potentially would be exporting and that we potentially would need to produce for ourselves if we weren't importing some of those goods?
Well, that's the supply side response they want. But as you know, Lisa, that's going to take time. Could take years. Could go beyond a second term, so President Trump.
I think that needs to be more of a focus. That could be a stimulus. It could also be something that juices inflation. Something we've got to think about.
If you want that grand realignment, it's not going to happen overnight, that's for sure. Up next on the program, Andrea Guerzoni of EY on growing confidence among global CEOs. That conversation up next.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
"60 minutes from now, we get some PPI data and jobless claims as well, so look out for that. Then later on this morning, we're all waiting for the same thing, a new tariff announcement from the President of the United States. Going into that, equity futures doing okay, just about unchanged on the S&P 500, just about positive on the Nasdaq 100, up by 0.05%. With 2 hours until the cash open, with your morning movers, here's Manus Cranny. Morning, Manus.
Jonathan, Cisco delivers despite the prospect of those tariffs hitting margins. So good that they've upped the guidance by $1 billion to $56 billion for this year. You can hear the wheels of AI churning out the money. This is about monetization. AI is becoming more pervasive, and we're going to surpass the $1 billion in AI infrastructure spend. MGM, let's all go to the casino, whether it's in Las Vegas or in Macau. Strong bookings, strong slot growth. China, record year for them on Macau. So a nice set of numbers for them there. Up just under 10%. I love this story on AppLovin. Love it. The stock was up 700% last year. This is the personification of the monetization of AI within advertising. You advertise directly to customers. You need a smart app to help you target your TV advertising, and this company is delivering on that. Ad sales up 73% year on year, and indeed it is all looking pretty rosy for them on the forward guidance. Jonathan.
That stock is flying in the pre-market. Manus, thank you. It's up by 27% in early trading. Let's get you some top stories on our radar this morning. President Donald Trump announcing today is the big one. In a post to Truth Social, Trump says reciprocal tariffs are coming after promising action sometime this week. The president is expected to sign executive orders at 1 p.m. Eastern time.
And you could expect concessions almost immediately from at least one of those countries that is going to be talked about today when it comes to reciprocal tariffs. And of course, that's India, with Prime Minister Modi set to visit Trump at the White House today. And what line just drops off right now in the terminal? Minister from India, the energy minister. Qatar, U.S. and Russia have offered India more LNG. Looks like India is willing to buy more Russian energy. They have already been making concessions leading up to this moment, and I'm sure today they'll come with more gifts.
I'm trying to understand the structure of this. Is the goal to reduce tariffs across the board, or is the goal to increase tariffs across the board and increase U.S. domestic manufacturing and production? Which is it? Is it to actually increase free trade in a pretty democratic way, or is it to raise revenue and potentially reignite some of the domestic manufacturing base? Yes, I guess. I'm not sure.
Remember the Oprah Winfrey election when it was spaghetti at the wall for taxes and all these ideas? This has more teeth to it. So let's say it's cannonballs. Some are going to land and some may not.
Yeah, I just keep going back to the ultimate goal. Are we reframing the whole world economy toward a pro-tariff type of walls up, get more sort of national dependence, which you're seeing, or is this let's get rid of all tariffs and foster free trade?
I thought you were going to say you get a tariff, you get a tariff, you get a tariff.
Reciprocity.
I hear that.
I hear that time and time again from people of this administration, often on the record. Reciprocity. That's what we're after.
There's different objectives here. Let's put it that way. We'll talk about them in just a moment. I want to turn to this story. President Donald Trump and Russian President Vladimir Putin agreeing to start negotiating on an end to the war in Ukraine. Trump saying on Truth Social he had a, quote, lengthy and highly productive phone call with Putin.
So this is the start of these negotiations. Trump said he wanted to end this war. A lot of criticism coming out of Europe after Defense Secretary Pete Hegseth is in Europe saying that NATO is not going to be a part of this. So for me, this feels like Trump is giving some sort of olive branch to Putin. He said a lot about that call, though. Not just that the two would likely meet in Saudi Arabia, which seems as a neutral ground for both of them, but also maybe Trump would go to Russia and Putin would come to the United States at some point. We are in a completely different era of U.S. foreign policy than we were even 2 months ago.
And it's leaving people in the European Union very concerned that they don't have an understanding of exactly how this is going to play out and whether they've got a seat at the table. Again, this goes back to the lack of leadership there, a lack of a clear view of how this progresses, a lack of a plan, and what they're willing to do. Are they willing to put peacekeeping troops in there? Are they willing to pay 3.5% of their overall GDP on defense spending? These are some of the questions percolating in that region.
I'll try and save my opinion on this occasion.
Oh, you have?
Okay, on this occasion.
Just rewind a little bit.
On this occasion, maybe an hour ago. But on this occasion, I just focus on the markets.
Okay.
What anyone thinks about the deal, the euro's stronger and crude was lower. And isn't that ultimately an endorsement of the deal from a market perspective on what Europe would need?
From a market perspective, it is ironic that this essentially is foisting the need to borrow potentially $3 trillion on the euro region that could potentially spur growth, that could potentially be exactly what the region needs to get out of its slow growth, slow evolution.
We've said this before. Perhaps these moves by this president forces the Europeans to do things that's actually good for them.
Yeah, it's the reason why it is such a difficult moment to invest, because then at the same time you can wonder if you get growth, well, what does that mean for the debt scenario and what the ECB can do? I mean, you start pushing this down, it's premature. Let's see if they get a deal done.
Let's talk about the Fed as well. Fed Chair Jay Powell wrapping up his two-day congressional testimony, telling the House Financial Services Committee that yesterday's CPI print means the FOMC has more work to do. We've got more data on deck. PPI and another round of jobless claims come in about 55 minutes' time. I have to say, listening to the Fed Chair, he didn't sound particularly vigilant when it came to inflation, with words like, I would say we're close, but not there yet on inflation.
Yeah, and when he talked about, we don't get excited about one or two good readings and we don't get excited about one or two bad readings, dismissing the January data is almost an aberration. And sure, there was plenty of discussion about weather effects really distorting things. That said, it has been 3 months of annualized inflation of about 4.5%, which is the fastest pace of inflation for a 3-month period, going back to November of 2022. It feels like something more than a blip at a time where he's saying inflation expectations aren't responsible for the 10-year yield going up. You know, we're still kind of on that steady disinflationary path.
I picked up on what you said earlier, and it's interesting. Playing down his contribution, the committee's contribution to the pickup in yields at the long end, when inflation expectations bottomed in the last 12 months around mid-September, which was shortly after we had that pretty aggressive speech in Jackson Hole, and just before we got a 50 basis point rate cut from the committee, which was followed up by another 25 and another 25. The yield curve steepened through last year, not just because of the tariff story and a Trump win and this pro-growth effort that everyone was expecting that could trigger reignite inflation. It was also much looser policy than expected from this committee.
What people were talking about was the likelihood that we could see real inflation coming down the pike from some of these policies in a way that would test the Fed's hand. He said, just to quote exactly what he said, no evidence long rates went up because of inflation. You did see real rates go up. This was a nod to maybe the deficit discussion. Either way, a real question of how to be political without being political by saying, maybe it's not, I don't know. Go take a look at yourselves.
That's when you want an interview, right? You want to have that follow-up
exactly.
question.
What are you saying? It did cause it.
Your time is up.
Exactly.
That's what frustrates me about all those hearings. Let's turn to the confidence. Confidence levels are still sky high. EY seeing growing confidence among corporate leaders in the company's latest global CEO survey. Sentiment around M&A also at an all-time high. Andrea Guerzoni of EY writing, there are indications that 2025 could see an uptick in mega deals, with 60% of global CEO respondents expecting to see an increase in deals more than $10 billion. Andrea joins us now for more. Andrea, welcome to the program, sir. Let's talk about the kind of deals that you and the team are looking for. What are we expecting here? Vertical deals or the kind of horizontal deals that were difficult to make happen over the past few years?
I have to say that it's difficult to say. There's a bit of uncertainty that is kicking in the last couple of weeks. Since we launched the survey, I think there's been a quite change in the landscape. But it's true. I mean, if you look at our confidence index, 74% of our CEOs are more confident that they will be able to navigate all this uncertainty. and those that are more confident have more appetite for deals, including mega deals. So that's really the outcome of this survey, and we expect really that in certain sectors there will be a search for new technologies and for opportunities to scale up. So we remain quite bullish, actually, despite the month of January, which has not been great in terms of deal activity.
Well, Andrea, you alluded to it. Let's unpack that a little bit more and build it out if we can. What do you think could possibly be holding activity back at the moment? What is it? Is it policy? Is it interest rates? What do you think it is?
It's all of this. I mean, if you look at the different forces that are shaping the M&A activity, I mean, we have quite a colorful patchwork of forces that are actually pushing for more deal making. I mean, there's a huge amount of dry power in private equity hands that needs to be invested. I think overall, the geopolitical situation, although remains very concerning, shows actually signs of improving. And if you look at the state of the U.S. economy, which is where the vast majority of the M&A activity actually happens, actually looks bright. Then you look at the other side of the coin, and you see that during the last 30 days, then the amount of uncertainty regarding policies, tariffs, taxes are impacting really trading flows and then capital flows as well. Interest rate is another fundamental driver to push investment, and interest rates is related, as you well know, to inflation, and inflation is still very uncertain. Actually, the latest data from the US are pointing to a slight increase instead of decrease, and this is causing uncertainty regarding the cost of capital, which may slow down the M&A activity. So you can see it's a very mixed picture.
Andrea, I want to pick up on one aspect that you just said, which is that the U.S. is where the bulk of the M&A activity is happening. Is that more than it has been in the past? Is it sort of the sucking sound of the U.S. and the growth story taking a lot of the energy from the M&A story, or is it pretty much the way it's always been?
It's pretty much the way it's always been, but with a big but, it's growing. If you look at the numbers, I mean, in January, the deal activity, I think, marked a $240 billion value, and almost 61% of this actually was generated in the U.S. It's really the sheer size of the economy, the fact that the GDP is growing, and if you look at the rest of the world, I mean, with what's happening in the UK, in continental Europe, you look at the economies in France, in Germany, and the situation in China, then you see why this proportion is increasing.
Andrea, is this a response to some of the policies that are coming out of the Trump administration, almost to act as an insurance policy that if you have some sort of footprint in the U.S., that will protect you from some sort of tariffs? Or is this purely on the pro-growth story that we're seeing coming out of the United States?
I think the overall sentiment this administration is pro-business, which helps. I think it's the stability of the overall U.S. environment. But I think that one of the most important angles for deal making, which again is a trend that is growing and can only go up further, is really the tech angle. The possibility really through technology, through AI, you can actually increase productivity and hence accelerate value creation. And actually, the action is in the U.S. So no wonder that there is a lot of investment activity, M&A activity in the U.S., because it's where really the vast majority of tech assets, tech knowledge is residing now.
But Andrea, to Lisa's point, how much do these CEOs need to incorporate political risk? A day like today, we're getting reciprocal tariffs, no idea what exactly they are going to mean, but there's a tremendous amount of uncertainty we're hearing from even the likes of CEOs like from Ford.
I think this is obviously a significant headwind for whoever wants to invest. I mean, not having really a stable picture regarding tariffs, and it's an issue. And all the CEOs we meet and we speak with, they are really working very hard to produce scenario plannings. They cannot really wait. They really need to keep themselves and make really some assumptions regarding what the end game is. Obviously, the longer this uncertainty lasts, and the more difficult really to execute the deals. But I can tell you, when we ran our survey in the last month of last financial year, there was a huge amount of optimism regarding the fact that after an initial period of, let's say, adjustment to the new administration policies, the situation would stabilize and the pro-business philosophy would actually prevail.
Andrea, before you go, I just want to double check. Are you an AC Milan fan?
I'm definitely a AC Milan fan.
There we go.
My family and we are struggling a bit, honestly, but I mean, the last couple of players joining us are promising, so we are looking up.
Last night was tough. I watched it too. I could tell we had a connection. I appreciate it. Andrea, thank you. Andrea Guazzoni there of EY, with a lot to say on Milan, I could tell.
Yeah.
Wanted to follow up there.
Yeah.
Last night wasn't good.
Clearly.
Yeah.
You lost to a
Wasn't great.
team that no one even has heard of.
Well, I'm sure the Dutch have heard of them, and I'm sure they're unhappy with that comment.
All I can say is, if you wanted to know why we had that interview, it was literally just for you to have that one moment.
Just wanted to double check. That's all. I didn't know that for sure. Just you can tell.
He could have been a Juve fan.
What was the give?
There was just a connection between us both, you know, and that's what it was. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Unfortunately, I have some more football news for you, but we'll get to that at the end. Elon Musk called to delete entire agencies from the U.S. government during a video call to the World Government Summit today. Since leading Trump's Doge, Musk has been vocal about reducing costs and improving government efficiency, most recently furloughing the majority of U.S. aid staff and freezing its funding. Blue Origin plans to cut potentially more than 1,000 employees. Sources tell us that the Jeff Bezos-backed company is looking to cut costs and focus resources on ramping up rocket launches after years of research and development. The space company's CEO plans to discuss the cuts at an all-hands employee meeting today. And as promised, the final Merseyside derby at Goodison Park was one to remember. Everton's James Tarkowski scored the final tying goal in the 98th minute, setting the Premier League's title favourites Liverpool. A brawl then ensued after the final whistle, with 4 red cards issued, including one to Liverpool's manager. Liverpool's lead over second-place Arsenal now sits at 7 points. And that's your brief. John.
What a finish. Best game on the planet. If you haven't seen it, watch the end of that game. Did you watch the clip last night?
Yes.
Yes.
Man, the eruption. I thought
A very unhappy house.
I thought that the stadium would absolutely collapse.
Liverpool fans at Bramo's place, just in case anyone's wondering. Up next on the programme, the Fed's long pause.
At face value, this is certainly not good news for the Fed. Look for the Fed policy not to act as an anchor for this economy, but to fuel volatility further. The pause button is going to be on a lot longer than what the market has been expecting.
Just a moment, don't miss this. We'll be catching up with Adam Posen of the Peterson Institute. He joins us next on the prospect of rate hikes in 2025.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equity futures on the S&P a bit softer here by 1/10%. In about 40 minutes' time, we'll get some data for you. We'll get PPI and jobless claims. Look out for that. Going into it, bond yields lower by 2 basis points. The 10-year 459.74. Under surveillance this morning, the Fed's long pause.
At face value, this is certainly not good news for the Fed. If we could talk about what is the right inflation target for an economy going through massive structural change, it would not be so obsessed with 2%. It will be flexible. There is no meaningful forward policy guidance coming from this Fed. And that is the mistake. Look for the Fed policy not to act as an anchor for this economy, but to fuel volatility further. The pause button is going to be on a lot longer than what the market has been expecting.
So here's the latest this morning. Markets bracing for President Trump's reciprocal tariff plans and its inflation impact after a hotter-than-expected CPI report just yesterday. Adam Posen of the Peterson Institute writes he is convinced and worried that they will put across-the-board 15% tariffs and allow Trump to go up from there. Notwithstanding Powell's we have to wait and see attitude, this will be inflationary unless it provokes a recession. Adam joins us now for more. Adam, welcome to the program, sir. I just want to unpack that quote piece by piece. Can we start with the Powell piece of it? The Powell's we have to wait and see attitude. Do you think that's contributing to higher inflation expectations?
Yes, I think it is, John. I think it's clear. I mean, you and I and Lisa and Anne-Marie have been talking about this for months. I agree with one piece of what Mohammed said. There's no forward guidance in a meaningful sense from the Fed. Forward guidance can be cheap talk, but this data dependency, short-term, misleading things. I mean, the idea that they were so convinced that the unemployment rate was a be-all and end-all measure of the state of the economy when all the evidence was otherwise. It's just a series of not the worst mistakes, but not good. Now, is there a huge erosion in inflation expectations compared to the past? No, but just as we remember with Volcker 40 years ago, when you didn't kill it in 82 and you let it get back in 85, it was hard to kill the second time, and that's what we have to worry about.
Adam, a lot of people have come on this show and made the argument that tariffs are a one-time price adjustment, but otherwise are disinflationary on the margin over time as they do reduce demand on the margins. What's your evidence, or why do you think this time is different, that the tariffs that Donald Trump is proposing to implement will actually have a significant inflationary impulse?
Lisa, I think there is a chance that it is more recessionary than inflationary because it is a tax hike, and it's a tax hike in particular on consumers and high-end businesses at the end of the supply chain. It also potentially could cause trouble by recessionary type trouble by creating shortages or unavailability of certain goods between retaliation and tariffs and other disruptions. But in the broad, in theory, it's a relative price hike, but in practice, what we've seen in country after country in the US in the past is that companies do have a certain amount of pricing power. It's not greedflation, but they're not going to passively sit there and let the price hikes made to them go unanswered. And additionally, we know that there is multiplier effects that you start off, you're putting taxes on something that's a basic input like steel or aluminum or chips for that matter. And then it cascades up the value chain and up the goods being sold. So It's, in theory, you could always have it be just a relative price shift, but then in practice, it's very unlikely. Finally, what you just said is if inflation, or Jonathan raised, if inflation expectations are a little bit flexible or uncertain, that makes it more likely that when you get a price shock, the Fed cannot just look through it.
Adam, if today is a template, the threat of retaliatory tariffs could prompt a lot of trading partners to actually come to the table by reducing their tariffs. How much are you looking at just this being a rearranging of trading partners more than, say, an increase in tariffs if it actually leads to lower tariffs in certain locations?
That would be fine, obviously. I mean, if it the piece of this that is difficult is that would mean the U.S. would eventually take off its tariffs to match and incentivize and lock in where others take down their tariffs. And so it would not be the nicest way, but it would be a way to get further trade liberalization. And so that would be fine.
Well, Adam, one thing
there's very little evidence that is the intent here.
Well, it might be, though, right? One thing I continuously hear from the Trump administration is reciprocity, reciprocity. March 12th, that's when those tariffs will come on for aluminum and steel. So there's a pause on that. March 4th, potentially. We don't know what's going on with Canada and Mexico. April 1st is really the memorandum when it comes to looking at these trading partners. At the moment, besides China, isn't this still in the negotiating phase?
It's in the threatening phase. So we'll see whether it's negotiating or threat. Either way, again, one always is glad when somebody does a bad policy. It removes a bad policy. So if the Trump administration, despite the president's statements, despite Peter Navarro's statements, despite everything they've been saying, this ultimately is just a gambit to get tariffs reduced abroad. And as Lisa said, it just reshuffles who you're trading with. Fine. I mean, it's not great. It's uncertainty. It's a little bit of government intervention and pricing that we don't really need, but fine. I'll be very happy if that's the outcome.
We'll see what the outcome is. Adam, thank you, sir. Adam Posen there of the Peterson Institute. Adam, who's just been phenomenal on the Federal Reserve, tracking back to August of last year. And for those of you not familiar with the way Adam's been thinking about things, came out in August of last year, wrote a piece and said, basically, dear Chairman Powell, as you get together in Jackson Hole, think about what you're about to say and prepare this market for two-way risk, because there could be some real two-way risk. Let's just say that Chairman Powell focused on one-way risk and it was downside risk to unemployment, or rather employment.
And then had to walk that back. And now we're looking at the fastest three-month average inflation going back to November of 2022. Adam Posen was the one who said the next move could be a hike. Yeah. You see and hear an increasing number of analysts saying the same around this table.
Came out so early saying that, and credit to him. Up next on the program, Bob Diamond of Atlas Merchant Capital, Tom Narayan of RBC, Andrew Holmhorst of Citi, Brian Weinstein of Morgan Stanley. Lots of data, 34 minutes away, PPI and jobless claims.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of the regulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Right now, I would describe the data as somewhat concerning, but not overly concerning.
At face value, this is certainly not good news for the Fed. And the bond market and the equity market is reacting accordingly.
They shouldn't overreact to this, but at the same time, they say there's nothing here which says that inflation is cooling.
The prospect for further rate cuts has diminished considerably.
Markets love certainty. They love predictability. We don't have that at the minute.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Equity futures this morning, and good morning. Slightly negative, down by not even 1/10%. No drama on the S&P 500. No drama yesterday either. We can talk about that later this hour. On the Nasdaq 100, we're positive by 0.06%. In 30 minutes' time, you'll get some economic data, PPI and jobless claims. Look out for that. And later, executive orders coming from the President of the United States at 1 p.m. Eastern Time. Either at that time or shortly before, we don't know. We might get this. We might get the big one. In the words of the President of the United States, reciprocal tariffs.
Which people have been waiting for, but expand out the potential parameters of not just where tariffs will go, but also how specific they are going to get for specific line items. This comes before his meeting with Modi of India. A bigger question from a market perspective is, are people going to look past this because the details are just so difficult to wrap your head around? So just watch the economic data, ignore that until it becomes real policy.
And look past it, because what Adam Posen said was we're in the, quote, threatening phase. That's what he called it as part of these maybe negotiations or warnings to other countries where the president feels like there's not a fair balance of trade. I maintain that given all of these tariff headlines, the only one that has stayed and actually stuck and went into effect was China, 10%. Everything else at this moment is paused. And what actually the president is doing at this moment is getting concessions already for potentially one of those countries that he's going to put reciprocal tariffs on, India.
And then Europe. Europe's in mind. Check out euro dollar. Look at this round trip on the session. Now totally unchanged on the day. So on the left side, you've got this ramp up in the euro. The hopes that there will be talks between Putin and Trump. And maybe we can address the war in Ukraine. On the right side, you've got that ramp lower. You've got that prospect of reciprocal tariffs on Europe. That's the tension in foreign exchange this morning.
The tug of war of whether your region will face a growth shock to the positive or to the negative, the positive being a resolution to the conflict in the region, that has really tightened supply chains versus seeing a real tax based on tariffs. What's the response? Is there enough cohesion in Europe to actually sufficiently respond to any of these threats?
They say they're going to, at least when it comes to tariffs. But when it comes to this peace agreement, the Europeans are going to feel left behind. And they already are starting to throw a lot of daggers at the Trump administration behind the scenes about this. Oliver Cook was talking about that. So I think this weekend is actually really, really critical when it comes to both these prospects, a peace agreement potentially and tariffs, because all of these leaders are going to be meeting at the Munich Security Conference.
Euro-dollar 103.90 and just about positive by not even 0.1%. Coming up this hour, Bob Diamond of Atlas Merchant Capital on the outlook for financials. We'll speak to Tom Narayan of RBC as automakers brace for additional tariffs, and Andrew Hollenhorst of Citi on why he's still looking for the Fed to cut interest rates. We begin this hour with stocks on hold, pairing most post-CPI related losses as markets adjust to high for longer for just a little bit longer. Joining us now is Bob Diamond of Atlas Merchant Capital. Bob, it's good to see you, sir. It's always good to catch up.
John, it's great to be here.
Outperformance from the financials already in 2025. Yep. You've got a big call. I want to start with your big call. We've got about 4,500 banks in this country right now. Yep. You think that can drop to 1,000 to 2,000 financial institutions in this country? That's a big move. How does that happen?
We think over the next 2 to 3 years, we're going to see a very constructive consolidation. We all know in March 2023, when SVB failed and followed up quickly by First Republic, you know, part of that was from 0 to 5.5% in interest rates. It kind of impacted every bank's interest rate portfolio and loan portfolio. Kind of the shock in commercial real estate hit that sector. But now it's very, very strategic, Jonathan. And I think because it's strategic, it's definitely going to happen. You have many of the smaller, you know, they've been there, the smaller, more private community banks that have been such a pillar of the community and so important to the economy in terms of serving small businesses, today are just too small to succeed. The impact of technology costs, but most importantly, the impact of the regulatory reaction to SVB and First Republic. So our view is that we're going to see the more successful, more well-capitalized regional banks have an opportunity to do business with a smaller private institution.
Is this true of the whole country, or do you see some of this activity concentrated in certain regions, certain parts of the United States?
Well, you bring up a very good point, which is much of this is about reducing costs. And if it's reducing costs, then you're going to see many in-state or close state combinations. So I think that's a good question.
One obstacle has been the regulatory environment in this type of tie-up, and the other has been valuation.
Yeah.
That people don't want to sell for what they think they're worth, if it's less than what they think they're worth. You're involved in some of these conversations. I'm sure you are, currently ongoing, and financing them, being part of them. Are people more willing to compromise on the valuation side of things now?
People are much more willing to look at the future. Whether it's a compromise, I probably wouldn't have used that word, but I think it teases out the issue, Lisa, which is it's in the best interests of these institutions if they're going to continue to compete for their middle market, you know, small business clients, family office clients, that the ability to combine and take out costs, particularly technology costs, which are duplicated, the credit department, totally duplicated, regulatory relations, totally duplicated, and anyone that is involved in consolidation, if the synergies are cost and you can identify them quickly, it goes right to the bottom line. And so too many of the smaller banks are struggling to get their ROE above zero, frankly, but never mind 10 to 15%. And we all know that the valuation of banks is driven by the return on equity. So I think this is, we're in a situation where it's good for these banks to begin discussing consolidation.
We've talked a lot about the deregulatory push of Donald Trump and how this would really spur a whole host of growth. And the point that it's raised around this table we've talked about is how much of the activity in lending has gone to private asset managers. If some of these banks do have more strength, will they be able to win that business back? Or is it a permanently cannibalized backdrop that is not going to revert back to the way it was?
Well, first of all, in terms of regulation, we believed in this thesis strongly under the Biden administration. But the shift from the Biden administration to a much more positive SEC. I mean, the SEC under Gary Gensler was not approving anything in terms of consolidation here, in crypto, and digital. Pretty much nothing was being approved that was positive for business in terms of combinations. That's going to change. I don't think that is a cause of this, but I think it's going to be an accelerator, which is we're in an environment where the government is going to be, and the regulators are going to be much more positive to constructive consolidation, which is, frankly, think about this. From a regulatory point of view, do they want more capital in the banking system? Of course. And you have institutions like Atlas Merchant Capital that are willing to put more capital for these combinations. And so it's a win-win all around.
To go back to where John began, you expect to see 4,000 go to 1,000 or 2,000 banks. Could that be in the next year, in the next 2 years, or do you see this as a multi-decade process?
2 to 3 years. I don't think it's multi-decade. I think it's 2 to 3 years. I think now is the time. I think many discussions are happening. And I think we'll see, 3 years from today, I think we'll see between 1,000 and 2,000 banks in the U.S.
But now is the time because of the policy.
4,500 banks. Come on. Let's be realistic. And there's many, the service that these institutions give to small businesses is incredible. So it is an important sector of our economy. It's an incredibly important sector of the financial services industry. And we know those two things together are why the U.S. economy is so strong relative to their peers. So this is going to be very constructive.
It's a lot of banks. You think it can get done 2-3 years, but that is because the changing of the guard in Washington, right?
Well, I think that will be an accelerator for sure. I think the approval process, the regulatory approval process, is going to be, positive behind this initiative as opposed to a blockage. And as I said, I think strategically we felt strongly that this was going to happen over probably a little bit longer time because it's necessary. These are strong banks. They're important to the economy. They need consolidation. They need to boost their ROE. There's costs ready to come out. All of this just makes perfect sense. And I think the attitude toward combinations and toward mergers and toward business, the attitude toward bringing more capital into the market is just much more positive under this administration.
Do you see them as competitors eventually to the big players on Wall Street, or just operating at a different part of the financial sector?
Well, they're in a different part, Jonathan, but competition's a wonderful thing, whether it's private lending competing with the banks. Has that improved lending for customers? Absolutely. If you have stronger regional banks, will the super regionals be stronger, and will they have opportunities? So competition's a wonderful thing, and I think it could sound like with 4,500 banks, there's a lot of competition. But if you had 1,000 to 1,500 stronger banks, better capitalized, then I think the competition would be better.
Bob, smart, as always. It's good to see you, sir.
Good to see you,
break this down. Thank you. Bob Diamond there of Atlas Merchant Capital with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Serious injuries in Munich after a car drove into a labor demonstration. At least 28 people have been hurt. Local police say the driver, a 24-year-old Afghan male, has been taken into custody. The alleged attack comes after a string of incidents in recent months. Pressure is building on German Chancellor Olaf Scholz to ensure security ahead of this month's federal election. Elsewhere, President Trump is expected to announce a round of reciprocal tariffs today. Trump posting on Truth Social that today is the big one after promising to approve the measure sometime this week. According to the White House schedule, Trump is set to sign executive orders at 1 o'clock Eastern ahead of his meeting with India's Prime Minister Modi. The State Department's procurement forecast removed its plan to spend $400 million on Teslas. The December version of the document had included a, quote, armored Tesla budget item that would span 5 years starting this year. However, newer version generically says, quote, armored electric vehicles. On X, Musk said, I'm pretty sure Tesla isn't getting $400 and that no one mentioned the deal to him. And that's your brief, John.
Hey, Danny, thank you. Appreciate the update. Much more in 30 minutes' time from Danny. Up next on the program, the Morning Calls Plus, Tom Naran of RBC as the automakers brace for additional tariffs from the President of the United States, Donald Trump. We're looking out for those reciprocal tariffs. It's the big one, apparently, coming up a little bit later. Live from New York City this morning. Good morning.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
So the opening bound 1 hour and 15 minutes away. The data 15 minutes away. PPI and jobless claims. The equity market shaken up as follows. The equity market negative by not even 0.1% on the S&P. It's time now for some morning calls. First up, Bank of America double downgrading Kraft Heinz to underperform, saying it struggles to see a path to meaningful sales growth this year. That stock is down 1.6%. Your second call from Wells Fargo raising its price target on Home Depot to $450, expecting it to re-enter upward revision territory. That stock is just about unchanged. And finally, Wedbush reiterating its outperform rating on Tesla, saying the deregulatory environment will fuel the autonomous driving story. That stock is up by 2.3%. That stock has struggled over the past few weeks. Let's stick with the autos. The industry bracing for President Trump's across-the-board tariffs on all steel and aluminum imports, and possibly retaliatory tariffs going on as soon as today. Tom Naran of RBC writing, these tariffs appear to have a better chance of being implemented than last week's on Canada and Mexico. That said, most investors we spoke with do not believe such tariffs will be permanent. Tom joins us now for more. Tom, good morning. It's good to see you. That's just steel. Then we've got to think about Mexico and Canada. Now, we've also got to think about the European players and what they might face. How are you and the team thinking about so-called reciprocal tariffs and what it might mean for European autos?
Yeah, I think we saw this whole script play out in 2018, where actually none of those tariffs were actually implemented. What we wound up happening is steel and aluminum did happen for about a year, and the automakers handled it quite well. Most investors I speak with don't actually think we'll have permanent tariffs, reciprocal tariffs, etc. I mean, there's a lot of devil in the details here, but that's kind of where I think the consensus.
Can I get into the logic and just ask why? Because when we talk about this and we acknowledge that Europe has higher tariffs on than the United States, 10 versus 2.5, kind of makes sense that US tariffs come up. Why did no one believe that?
Well, because we've had evidence where it hasn't happened. Also, it's unclear that tariffing European imports would actually help the U.S. auto industry, right? So, like, I've said this before, like, the person buying a Shelby Silverado is not the person buying an S-Class, right? So the U.S. auto lobby isn't really calling for it necessarily.
I want to talk about U.S. automakers because the Ford CEO is making a lot of trips to Capitol Hill. He was there yesterday. He said that these tariffs would be devastating and blow a hole in the U.S. auto industry. How concerned are they about this pause we're seeing at the moment, but potentially that could hit after March when it comes to Canada and Mexico?
Yeah, I mean, obviously he's going there for a reason, right? And he's saying that it'll blow a hole for a reason, right?
But will it?
It's a political game. If they're permanent Mexico-Canada tariffs, not the steel aluminum, the Mexico-Canada tariffs, that would be a disaster. But I think what he's illuminating is a fact that, you know, in his words, how well thought out are these tariffs so far? For example, what happens to the Japanese and the Korean imports? They're not included there. So you're punishing U.S. automakers for producing in Mexico, but you're allowing the Japanese and the Koreans, right? So that's something he noted. There's also, like, what happens if you produce a battery in the U.S. and ship it to Mexico to assemble a car? Is that included? So I think he's just highlighting the fact that permanent tariffs on Mexico would be disastrous. But I think that fact alone is why investors think they probably may not happen at all, because there's a lot of questions.
Something else CEO Jim Farley is talking about is the IRA, the Inflation Reduction Act. These U.S. automakers sunk a ton of capital into EV because of the subsidies they were getting from the Biden administration. And he's making the point politically that a lot of this money went to red states. What is your base case? Does some of this money stick?
Yeah, so I think we need to separate out the two parts of the IRA. One's the consumer credit, right, the $7,500 credit. That's looking more and more like that will go away. And to be fair, the Biden administration was looking to take away the lease component of that. So that was already on thin ice. But the other piece that remains is the 45X making batteries in the U.S., in, like you mentioned, red and purple states. That seems like it's probably here to stay. So it's a mixed bag. It's going to have an impact to remove the consumer credit, no doubt about it. But keeping the battery credit, I think that remains. That still helps the D3 who are doing, notably GM, that's building batteries domestically.
We've been talking about what the framework is for some of these tariffs, what the goal is, and one of the goals that we keep coming back to is to increase the amount of manufacturing in the United States. For some of these auto manufacturers, especially with the increase in automation, the fact that you can do things more efficiently, is it feasible in a way that it hasn't been, say, over the past 10 years, to increase some of the production domestically in a way that isn't necessarily cost prohibitive?
Yeah, it's a great point, right? I mean, I tour auto factories all the time. I'm sure you guys as well. You notice a lot of robots, right? Now, that said, there is an impact. I think GM had said just this week that in the near term, they could mitigate the tariffs on Mexico by as much as 50 to 60% by moving production to the U.S. Now, that's a temporary fix, right? Because what happens to those plants you have in Mexico? That's a stranded cost. And now you're over-capacitizing the U.S. production. So it's not like it wouldn't have an impact. They probably, if there are permanent tariffs on Mexico, of course they would have to reshore. It would be very costly to do so.
I guess this goes to this question of the European automakers as well, because we had another announcement today that Porsche was planning to lay off almost 2,000 roles in Stuttgart in Germany. This comes on top of the 54,000 layoffs in the auto industry last year in Europe. At what point are we talking about either an industry that's got over capacity globally, or are we talking about an industry that isn't as people-intensive as it has been traditionally at a time of a lot of technological advance?
It's probably a combination of the two, right? I mean, VW had all of those discussions, to try to shut down plants for a reason. It's overcapacitized. You have Chinese competition coming in. They're probably going to have to do JVs with the Chinese companies. What does that mean for the profit pooling? They'll have to share that. Probably means you need less labor. And it's also this automation point. That is absolutely true. If you compare SG&A as a percentage of sales of the U.S. automakers compare it to Europe, you'll notice the difference. Not just in autos, by the way.
Pop quiz. Who's got the answer to this one? Biggest automotive exporter in the United States of America. Who do you think it is?
Kia.
BMW.
Oh.
And has been for a number of years.
All right.
And that plant they've got in South Carolina is one of their biggest plants. Spartanburg. Now, why don't we have a talk about this? We should talk about this all the time. How did that happen? How did we end up with one of BMW's biggest plants, perhaps even the biggest plant, being in South Carolina? How did that happen?
Well, the U.S. is a really important market. It's cheaper to localize, closer to where your end market is. Remember, they make large SUVs there. And so does Mercedes, has one in Tuscaloosa, too. So that's where the large SUV market is the U.S. Producing locally just cuts costs.
So shouldn't we want to see more of this? Shouldn't that be the model? Ultimately, if the president wants to see more of that, shouldn't we go to BMW, work out how that happened, and figure out what we need to do to see more of it?
Probably, yeah. That's why I think what Jim Farley at Ford was saying is this hasn't really been potentially well thought out, the details like this. That could be a solution, absolutely.
And is another solution potentially vice versa? Trying to get Ford, GM to produce in Europe, sell more cars? It's a big grievance of the president.
Yeah, could be. That could be what happens. But, GM is not really in Europe. Ford is. Ford does produce there. But yeah, maybe that is something that winds up happening. You wind up producing more locally in the region you want to sell to.
In the meantime, John keeps talking about this every time we get a stock analyst, stock investor. How can you say that this industry is investable if you're not getting clear policy and you don't have a sense of how much you're going to have to rearrange? What do you tell them?
This is the question I get all the time. It's kind of like the math you have to do of, let's say there's a 1% chance of negative infinity, right? And a 99% chance of everything is fine. If you do a blended average, you get negative infinity, right? But how useful is that math, right? So you have to, as an investor, kind of look at that probability and say, this is kind of like, I used to be an investment banker, garbage in, garbage out math, right? How useful is that math? You have to potentially hedge. You have to, come up with your own call of what you think will happen. It would appear the investors I talk to don't think we'll get that negative infinity scenario. So there seems to be a lot of panicking about it, but maybe we need to kind of be more rational, like some of these investors I speak with, and, think about it from a kind of a more pragmatic standpoint.
Hey, Tom, always good to see you.
You got it.
Just a final question. If we get reciprocal tariffs on autos and those stocks gap lower, are you saying they're a buy?
I think so, based on what I speak with investors, because they don't think it's going to be permanent. We have evidence to suggest that that they haven't been in the past.
Okay, we'll see what we get a little bit later. We'll see if it sticks. Tom Leran there of RBC. Tom, thank you. Looking out for reciprocal tariffs a little bit later today.
To me, that was a clinic on why the market is not responding to a lot of the tariff threats. If you can't price in negative infinity, which my father is very upset about because it's not really a true mathematical concept, but carry on. If you really just bank on negative infinity, no, he's not watching, but sorry, Dad.
He doesn't do TV.
No, he doesn't. He's probably thinking. But I just think, it sort of highlights why people discount that whole concept at a time of a great deal of uncertainty.
True, but only thing I would push back on Tom on is we're in a different political environment this time around. Donald Trump is not running for president again. So maybe he does want this global realignment on trade, and these tariffs do stick.
We're living this real time. We're going to find out, aren't we? Time will tell. Equity futures right now in the S&P 500 negative by close to 0.1%. In just a moment, economic data will get PPI and jobless claims and reaction from Andrew Hollenhorst of Citi, Brian Weinstein of Morgan Stanley. That conversation coming up very shortly. Live from New York City, to Lisa's point, this market's staring down the barrel of more tariffs and not doing much in response. Your equity market is unchanged.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Real-time update from Casa Bramo. Got time for this, haven't we?
I feel like I'm in math I don't know. We actually, that evidently there is something that can approach negative infinity as the sequence gets smaller and smaller. We are 15 seconds away from key economic data. This is unnecessary.
Love that.
Sorry.
That's perfect. Your scores look like this in the equity market. We're negative by about 0.1%. In just a moment, PPI and jobless claims. Breaking down that economic data. Let's get to Mike McKee. Good morning, Mike.
Good morning, everybody. Well, we've got the PPI numbers coming in hotter than anticipated, much the same as we saw with CPI yesterday. Final demand headline number up 0.4 on the month. So on a year-over-year basis, we're at 3.5%. Ex-food and energy, 0.3. The forecast was for 0.3, so that one's online. But remember, last month it was 0. No change. So on a year-over-year basis there, we're looking at 3.6%, up from 3.5. And then the ex-trade numbers up 0.3, which is more than anticipated, and that puts us at 3.4%, up from 3.3. So we are seeing some pipeline inflation pressures. We'll have to take a look at what those came from. Jobless claims, though, better news. 213,000. Last week's 219 revised up to 220, so it's a drop of 7,000 overall. 1,850,000 on continuing claims, down from 1,886. So the jobless claims side of the Fed's mandate doing okay. The inflation side, still a bit of a problem.
Mike McKee, thank you, sir. Stay close and we'll get some of those details in just a moment. So that's the right kind of downside surprise on jobless claims and the wrong kind of upside surprise on PPI. Off the back of that, Treasuries cheapened just a little bit. Yields were down by a few basis points, now down by just 1 on the long end on 10s. At the front end, now just about unchanged on the session. Off the back of that, the euro, a bit more weakness against the stronger dollar. Euro-dollar down to 103.82 and now totally unchanged on the session. And in the equity market, looking at S&P 500 futures holding on to very mild losses. We're down by about 0.1%, and the Nasdaq 100 just about unchanged. So, Lisa, that's an upside surprise on CPI, followed by an upside surprise on PPI.
And this really feeds into that core PCE figure that Jay Powell was talking about yesterday, that they tend to look at to determine whether or not to adjust policy. I'm surprised there isn't more of a reaction in the bond market, I'll be honest, in the short end. So I would like to look through some of this and see what people are looking through. If you take a look across the board, not only is it above expectations with inflation PPI, but the revisions also are to the upside pretty much across the board, which again speaks to this question of why aren't we getting more of a pop in that 2-year yield?
Well, if you are just tuning in, welcome to the program. We do get hotter than expected PPI, an upside surprise there almost across the board following an upside surprise on CPI just yesterday. Mike McKee is still with us. Mike, you've had a chance to go through the details. What jumps out?
Well, it's interesting. It is final demand trade services that really push things up, according to the Fed. And remember, those are derived from margins at wholesalers and retailers. Over a third of the January increase for final demand services, which were up by 0.3, a sixth consecutive increase, came from that category that included trade, automobile retailing, truck transportation. Those were some contributors to it. We did see a bit of a decline decline in fuels, though. Goods were up 0.6 in January. That's the 4th consecutive increase, and it's another month where now goods have moved up in price more than services, reversing what we had seen before.
Mike McKee, thank you. To extend the conversation, joining us now, Andrew Honhorst of Citi. Andrew, you've had in the books for a while that you expect the Federal Reserve will reduce interest rates this year. I believe you think it's going to happen now sometime later on in the spring, around May time. How does this CPI number of yesterday and PPI this morning help your case?
Yeah, this definitely still is all in the column of the Fed is not in a hurry to reduce interest rates. That's what we've heard from Chair Powell. That's what we saw at the January FOMC meeting and in congressional testimony. So they're going to need to see some more evidence that inflation is cooling. I think they will get some of that in the PCE reading. Now, you want to be careful here. We have CPI, we have PCE, we have year on year, we have 3 month. You can look at all these different metrics on inflation. When you dig down into the details, the fact that shelter inflation is slowing down, I think that is going to give Fed officials confidence that we're getting some slowing. In terms of what this PPI number means, I think part of the reason the market is reluctant to react is you really have to look at these detailed categories and how they're going to play into that PCE reading that I think is going to be softer than the CPI reading we saw yesterday.
Well, Andrew, let's try and stay on the details then. When you think about the sources of inflation, energy, labor, goods, services, what do you think the source of disinflation will be through the next year or so?
I think the single biggest factor that is causing me to be confident, and I think will cause Fed officials to be confident that inflation is slowing, is a slowdown in shelter prices. Again, even though we saw a stronger overall reading for CPI inflation, we saw shelter prices that were slower yesterday. And if you look at what was strong in the CPI reading, it was really things like motor vehicle insurance, used car prices. These are more volatile categories and categories that don't get, in some cases, as high a weight in the PCE reading. So I think we'll see some volatility in CPI, but that through line, as Chicago Fed President Goolsbee would say, is still lower in inflation.
What would you have to see, Andrew, to change your view that maybe this is something that's a bit stickier?
Yeah, so what would be concerning is if you saw just a lot of residual strength in wages and in services prices. Now, we still have somewhat elevated wage growth, but it looks to be cooling. We know the labor market has softened, maybe it's kind of stabilized more recently, but softened before stabilizing. That should all mean that we get a glide down in wages, we get a glide down in services price pressure. If we're wrong about that and you were to see wage growth that was actually picking up again, that's where I would get concerned. That's where I think Fed officials would get concerned.
That's the reason why that was the number that people looked at in the jobs report, the payrolls report that we got last Friday, although it was explained away by the hours worked going down. I am curious about which aspects people are honing in on that are not necessarily inflationary. When you have fairly broad-based inflationary pressure, people had theorized that you would get this disinflation in services that was enough to offset a reinflation in goods. It doesn't seem like that's happening to the same degree that people previously expected. Why do you dismiss that?
Well, I think shelter services are on track. The non-shelter services, that is where we should be concerned. And again, it's this whole issue of wage pressure, labor markets, and does that bubble up into services prices? We saw that again in the January reading, this what we call residual seasonality, where people increase prices at the beginning of the year, and they increase prices by more at the beginning of the year, and we get these really strong January readings. So I'm really looking to see not just in the January inflation number, but what do we see in February, what do we see in March? I think those services prices are going to cool again in February and March. They were cooler in November and December. So if you put together, 5 out of 6 months that's cooler there, and you have wages that are slowing, that's a pretty good picture for the Fed. We have to watch these next couple reports.
Andrew, today's the big one, apparently, reciprocal tariffs. We've had this conversation about inflation without talking much about trade. Now, Andrew, you've got as a baseline interest rate reductions for 2025. How do you think about tariffs and the potential feed-through into higher prices? We've got 10% on China. We could have more still to come.
Yeah, so the details are what are really going to matter here, and we don't know the details. I do expect we're going to get some kind of broad-based tariff. That's been pretty core to the Trump administration messaging, to their economic policy. They need that both for incentives to produce in the U.S. as well as to raise revenue. The question is, are there any carve-outs to those tariffs? Are we including Canada and Mexico? That's almost 30% of trade if you include or exclude Canada and Mexico, so that makes a big difference. Also, are there carve-outs for certain products? That can make a big difference because some products you would expect those tariffs to be almost fully passed through into consumer prices. Most products you would expect those tariffs would not be fully passed through. So the inflationary effect will be less the more you get carve-outs and the more you focus on those products where you get less pass-through. If the inflationary impetus is not too great, then I think Fed officials can say, it's a one-time price level increase. It's not an inflationary pressure issue. The challenge for the Fed is going to be if inflation is not otherwise slowing, can you say that? So I think you need inflation to be slowing down just by basic macroeconomic dynamics. Then you need these tariffs to not be too great an extent. Then you will get a limited Fed reaction.
Andrew, that sounds a lot like transitory. And that argument's not a good one these days, even if they think it's the right one. You saw back in the middle of September that inflation expectations bottomed, at least market perception of inflation expectations. Andrew, the Fed chair, as Lisa pointed out, Chairman Powell kind of pushed back at the idea that they contributed to higher inflation expectations with 100 basis points of rate reductions. Andrew, can I get your thoughts on that just to wrap up? Do you think they did contribute to higher inflation expectations?
I think it wasn't so much the Fed rate cuts. I think it's more the expectation of tariffs. We see that in the consumer surveys where people say they're worried that prices on durable goods are going to go up. So I would see that as more tariff related. And it's the short-term expectations, one-year expectations, not the long-term expectations that Fed officials would worry about more.
Andrew, appreciate it. Thank you, sir. Andrew Honhorst there of Citi. That's the Fed's problem, Bramo. I think you've nailed it. When you really think about the distinction here, the Federal Reserve might sit there and say, this is a one-off price increase to the price level and we can look through it. Consumers aren't doing the same thing right now. Maybe that changes, but at the moment, they're not doing the same thing. And consumer expectations is something that spooked the Fed last time around. Does it spook them this time around?
At the same time that you're seeing companies actually successfully raise their prices, that's what we have to keep going back to. Not only are consumers maybe not looking past this, but companies are trying to get ahead of this and might even be jacking up prices in anticipation of those tariffs to get a bigger cash pile to gird against whatever might come down the pike. Unclear if this is going to be a real mirror image of what happened in 2017, 2018.
Brian Weinstein at Morgan Stanley joins us now to talk about the market impact in the bond market right now. Brian, yields are dropping. We're down 5 basis points on a 10-year, 457. We're down 4 at the front end, 431. I guess why is the first question, and the second question is, would you do the same thing?
Yeah, why? Who knows? I mean, these markets are choppy. They move around. Listen, I think what's happening, John, is we've done a really good job of pricing in a lot of this inflation risk, right? I mean, break-evens are higher, yields are higher. I think what the market is going to switch to is worrying about the growth side of this equation. So you can't raise prices and raise uncertainty and continue to raise growth expectations. And you know that I've been bearish on interest rates. I think eventually we'll get to 5.25. I don't think that time is now. I'd actually be a buyer of interest rates here. I think rates could fall a bit. I think we're overextended on growth. I think risk assets have done well, but they've kind of started to peter out. And so I think what the market is anticipating is that we're going to shift this conversation to the growth impact of all this uncertainty and the tariffs.
Brian, are we seeing that in anything tangible, that there is a growth impact that's starting to feed its way into markets, but also the companies that everyone is looking at?
Listen, I think you've seen it in some earnings, right? You've certainly seen it on the lower end consumer. I think you see it a bit in the yield curve, right? I mean, listen, the long-term trend here is steeper. We can go a lot steeper given deficits and things like that, but we've stalled, right? So you don't see that fear. And I think taking the Fed out of the equation, right? The idea that we know they want to ease, they always want to ease, but they can't do it here, right? They definitely contributed to higher inflation expectations. They definitely eased at a time that was a bit inexplicable, and they're stuck a little bit as tariffs come in because it's not going to look good. So the Fed can't go. You see some weakness in some low-end consumer. And so I think you're at the very, very fringe. I don't think it's today. It's not in the next hour. This is coming up in the next couple of months. I think we shift into that growth fear. This is just the early edge of it.
A lot of people were saying you would see that in the initial jobless claims, and that really is going to be the data point, the high-frequency data point to watch. We just got it, at 213,000, below expectations, pretty much in line when it looked at the revisions of last week. We're not seeing it affect the labor market, and real wages are actually increasing to some degree. At what point do you need to see confirmation in some of this labor market metric in order to continue believing that the growth shock is going to become the preeminent concern that plays out in markets?
Right. Listen, I think you will see it eventually. I think companies are doing a better job of not overreacting. So I don't think you're going to, again, this is not a call for some type of massive, down trade. This is just saying, you could go off 5 or 10%, and jobless claims will trickle higher. I don't think you're going to see massive layoffs. So you'll see it in jobs, but I think you're going to see it more in earnings. I think you're going to see it more in consumer behavior. And so, yes, that will trickle through to jobs. But listen, jobless claims has been amazingly stable. We have a lot of dynamics going on, I think, in the labor market with immigration and things we don't truly understand how they're playing through. And so I'm not looking at every Thursday being like, today's the day, and I'm not a big risk off guy. I just think that this is the stage in which we've moved real rates really high. Growth expectations are high. Inflation expectations are high. I think listening to Andrew, I don't think they're easing in May, but I think the pieces are there to say we've pushed this as far as we can push it in terms of growth and inflation expectations and interest rates.
But how are they able to ease this year when there's so much policy uncertainty? I mean, today we're waiting on this potential reciprocal tariffs we're going to get from the White House. How is the Fed able to do anything until there's real clarity?
Well, you know my view. I don't think the Fed is in play. I don't think they can ease. Even if you start to get some weaker growth, again, we're not talking about really weak growth. We're not talking about, I don't think, a recession. So if inflation expectations are sticky, which they are, again, even if inflation comes down towards 2, I don't think anyone really expects it to go below 2. So we're talking about inflation of 2 to 3 or 2 to 4. So the Fed, I think, has a problem unless you get a real growth shock. I would say I think the Fed can ease this year. I would put it September, October, November kind of time frame on it, because I just think between now and then, unless I'm wrong and you do get a huge downside surprise, they're stuck trying to prove to people that they're fighting inflation, and that is going to take a little bit of time to prove. The growth side, even if we come down a bit from these valuations, I still think we're okay.
Brian, just to wrap it up, spent a lot of time on rates and what you would do in fixed income. I just want to finish on what you do with risk assets. Credit spreads, as you've noted, struggling to make new tights, equities struggling to make new highs. What signal do you take from that?
I think people are still going to gravitate towards quality and income, especially in fixed income. But on the equity side, and therefore I think on the high yield side, I think some of these assets where cash flow is not as strong, where credit quality is not as good, I think you're going to get a correction both in the riskier part of the equity market and in the kind of high yield side of the fixed income market. So as someone who still thinks if we get to high yields in say 6 or 8 months when we're through this growth scare and get to tighter credit spreads, I don't think I'd play that now. I think I like duration a bit more. I still like quality, but I'm a little bit more bearish on credit spreads for the next couple of months.
Interesting, Brian. Appreciate the update. Thank you, sir. Brian Weinstein there of Morgan Stanley. As we look at the bond market, it's rallying. Yields are down across the curve. On a 10-year, we're down by 4 basis points. On a 2-year, we're down by 3. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. A quick recap of the data from moments ago. U.S. wholesale prices picked up in January on higher food and energy costs. PPI for final demand rose 0.4% from a month earlier. That is higher than the median forecast of 0.3. Compared with a year ago, the figure increased 3.5%. That data comes after yesterday's hotter than expected CPI print. Elsewhere, Hamas said that it will free hostages on Saturday as scheduled. At least 3 Israelis held by the group are set to be released in the next round of phased exchange for hundreds of jailed Palestinians. Hamas had previously threatened an indefinite delay in the swap, citing Israeli truce violations. The leaders of Canada's provinces and territories have met with U.S. lawmakers in Washington to lobby against President Trump's proposed import taxes and tariffs. The premiers emphasized the importance of a good relationship between the two countries to keep prices low for America and urged the U.S. to reconsider its tariff plans. And that's your brief, John.
Danny, thank you. Appreciate it. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. It's the big day. Reciprocal tariffs coming from Washington, D.C. We'll get you an update from the nation's capital in just a moment.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
So this is the setup going into the opening bell. Equity futures on the S&P positive by 1/10%. Likewise on the Nasdaq, outperformance on the Russell. Check out the bond market, a rally. Yields down across the curve. Now why? We just got hotter than expected PPI following hotter than expected CPI. Details matter here. Big thanks to the Bloomberg team just for flagging this one. The categories in the PPI that feed into the Fed's preferred inflation gauge were more favorable for the month of January. So we're trading on the details beneath the surface of PPI. A lot of nuance to this morning.
They're looking at things like declines in most healthcare items and airfares and tangible components that go into that core PCE metric that Jay Powell pulled out yesterday in the hearings and said was 2.6% as evidence that it still is on a progression of downward moves.
So that's the economic data. Then we've got to work with this one. Check this out. 1 p.m. Eastern Time. News conference on reciprocal tariffs today in the Oval Office. This coming from the President of the United States. Make America great again.
And he's supposed to be meeting with the Prime Minister of India, who potentially is going to be on that list for reciprocal tariffs. Trump earlier this morning, he said that they're coming today. Yesterday he said maybe today, maybe tomorrow. The question is, what are the scope of these? Is there going to be a long timeline? And potentially, is the president willing to use this as a negotiating tool? And is there going to be enough concessions from these countries or the European Union, from the continent, in order to assuage his concerns?
We said it first thing this morning. This is the most fascinating time in financial markets worldwide since the pandemic. Let's get you some morning movers. Let's cross over to Manus Cranny. Morning, Manus.
Jonathan, that confidence carries through for Cisco. So confident are they? Even in the face of tariffs, they're raising the guidance up $1 billion to $56 billion for this year. AI is boom time. We're firmly on track to deliver over $1 billion of revenue in AI. The personification of a slowdown in Deere, down 4.5%. This company made $869 million. A year ago, it was $1.75 billion. North American sales will drop by 30%. Just think of the headwind if those 25% on steel and aluminium endure. AppLovin, wrap it up with this, stock up 700% last year. They're helping that direct-to-consumer funnel and target their clients on TV. It's the app. If you're in direct-to-consumer, this is the advertising system you want.
Manus Cranny, thanks for the update. A few names to watch going into the opening bell and something new to watch later on in today's session at 1 p.m. Eastern Time. The President of the United States holding a news conference on tariffs. Then tomorrow, more economic data will get retail sales. Plus, the Munich Security Conference begins before we get a long weekend stateside. Before we get to that long weekend, we've got a big news conference coming up a little bit later. Joining us now from the nation's capital, Tyler Kendall of Bloomberg. Tyler, what are you looking for from the President at 1 p.m. Eastern Time?
Well, John, one of the biggest questions is what the timeline for these reciprocal tariffs would be. As we've seen in the past, particularly with those steel tariffs that we've been discussing, he left kind of a long timeline, right? 4 weeks, essentially, for these negotiations to start to take effect before they go into place on March 12th. So how long will those negotiations be, and what sort of exemptions we could be expecting? There was preliminary reporting that maybe countries wouldn't necessarily be exempted, but that we're going to be watching some key industries, including autos and pharmaceuticals, and whether or not there will be any exceptions there. Of course, we had known that this was coming today before India's prime minister touches down at the White House. He is expected in the 4 p.m. hour, and we are still expecting a joint press conference between him and President Trump later on in the 5 p.m. Eastern hour. So big questions there, particularly if perhaps India can get ahead of this and make any concessions to President Trump, as we've already seen them starting to put out there that they are slashing their own tariffs in a bid to prevent against these.
Tyler, paint the scene of how this might actually happen. We're going to have tariffs potentially on India at 1, and then Modi comes in at 4. What is the president after?
Right. Well, we know that they're immediately going to go into this closed door bilateral between the two leaders. But as we've been reporting, they have been in negotiations ahead of this. We know that administration officials in Modi's administration have looked at upping LNG, also upping imports of defense weapons from the United States. Now, remember, Anne-Marie, as you know, this is likely making good on a campaign promise from President Trump that he wanted to impose universal tariffs. So while this might not be universal in the sense, there is this sense in Washington that reciprocal tariffs will essentially accomplish that goal to have a widespread tariffs to hold these nations, and as President Trump says, accountable. But at the end of the day, we're going to have to see whether or not this is a negotiating tool or if this is going to accomplish that rebalancing trade priority that we have often heard President Trump speak of.
Tyler, thank you. Appreciate it as always. Thanks for this morning. Tyler Kendall. We'll give you that coverage a little bit later on Bloomberg TV at 1 p.m. Eastern time when we expect that news conference. Bramo, here's the deal for markets. Point 1, what are you looking for? How big are the tariffs and on who? Point 2, do you think they're going to stick or not?
At what point are they not just negative infinity in your calculus? And that, I think, is the key point that I took away from this morning.
Well said. That and a whole lot more, of course.
Yes,
3 hours of program.
lots of stuff.
Obviously. Tomorrow, the lineup looks like this. Jim Bianco of Bianco Research, Peter Chia of Academy Securities, Lindsay Piegza of Stifel, and Amanda Linen of BlackRock. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I never. Go.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Today's the day. Reciprocal tariffs coming, and the market doesn't care. Futures higher with 30 minutes of to go until the start of trading. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, producer prices picked up in January on higher food and energy costs, highlighting only limited progress on inflation.
Donald Trump says today is the big one. The president announces reciprocal tariffs, but he doesn't give us any detail on what, how, or when. We're waiting with bated breath.
And from Deere to Coca-Cola, corporate America braces for the fallout from those tariff threats. All that and more coming up. But let's take a look at these markets. Like Matt said, shaking off the threat of reciprocal tariffs, shaking off, of course, that hotter than expected PPI that we got at 8:30 a.m. Right now, the S&P 500 higher by about 0.2% pre-market, shaking off also what we saw yesterday, slight declines. You take a look at the NASDAQ 100, same story, up a little bit more, actually, when it comes to your big tech index, currently higher by about 0.3%. Maybe Jim Caron can explain the bond market to us in just a couple of minutes, because right now you have 10-year yields falling down about 5 to 6 basis points, even though we got that hotter than expected PPI following up on what we saw with inflation yesterday.
I love it. I love it. It's crazy. Take a look at markets right now. If you don't believe me that they really weren't jarred by the tariffs, the yellow line is when we got Trump's tweet or his truth or whatever we call it. You can see here the white is S&P futures, the blue is the Bloomberg Dollar Index. We had a lot more movement before that, and we've been steadier since. So the market just doesn't seem to care. He's kind of the boy who cried wolf.
Is it the big one? You know, the macro is driving the story, but you know what? It's still earnings season. So we are going to look at some of the stocks under the surface. Interesting things in the technology world. Reddit is down 5.8% pre-market. They had missed estimates. The company says that a change to Google's algorithm had impacted search traffic and therefore ad revenue. We're also looking at ad tech giant Trade Desk, plunging after a rare forecast miss. Ooh, it's just taking a beating here, down almost 30% pre-market. Analysts say the company faces a correction after consistent 20% growth. Robinhood up more than 12% pre-market. Revenue doubled year over year, and retail investors had made bets on the election, you might remember, for the first time. The company also saw a 700% jump in revenue, in crypto revenue last quarter as well. We're going to discuss that and more with Robinhood CEO Vlad Tenev at 10:30 a.m. Eastern, Matt.
I'm very much looking forward to that interview. So much going on in terms of what's coming out of the Trump White House, right? I mean, you've got, well, for Vlad, hopefully reduced regulation. I saw Bob Diamond earlier today said he thinks there's going to be a wave of small bank mergers because of that. But you've got also what's going on in Ukraine.
Yeah.
Will he make peace there? Is he going to give half the country to Vladimir Putin in doing so? And then obviously the tariffs.
Yes.
I think you're going to see. There's a possibility that EU passenger vehicles are going to get higher tariffs.
Well, we have that press conference coming up at 1 p.m. Don't forget the economic data. We got PPI at 8:30, and there's a line to draw between, of course, what we're seeing on the inflation front, on the PPI front, and what we're seeing with tariffs, because, of course, we're talking about the revisions. They were meaningful as well. The headline was hot. All of this is before the tariffs actually went into effect. We're having trouble taming inflation and keeping it down at these levels even before we put in place some of these levies. So it's a really tricky picture, not that you're seeing it reflected in futures right now.
Yeah, or the bond market, as you've been saying. What's interesting, too, is Torsten Slott's note this morning brings up what a lot of investors have been looking at over the last couple of months, is whether we will face that repeat of that 70s type persistent inflation or re-acceleration even. Totally scary.
Matt, tell us about it.
I'm a little intense.
But let's see if regulation and the like will actually lower rates like the administration would like. Speaking of the administration, President Donald Trump vowing to announce those reciprocal tariffs today at 1 p.m. in the Oval Office. Joining us now, Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. What are you expecting out of today, especially when we're in the midst of a lot of geopolitical changes, too, happening at the heels of the White House?
Well, based off what we've already seen from the president when it comes to tariffs, and we've only had 3 weeks of this administration in full, what we've seen is President Trump in a negotiating mode, or as Adam Posen of the Peterson Institute told us during surveillance, he says it's threatening mode. Because look at the tariffs that Trump has been talking about every single day, and the only ones that have actually stuck are the Chinese 10% additional tariffs on those Chinese imports. When it comes to Canada and Mexico, that's on pause till March 4th. March 12th is now the new deadline for these potential steel and aluminum tariffs. So I think with these reciprocal tariffs today, potentially this is going to be Trump in negotiating mode. And it's also coming at a time when the Prime Minister of India will be heading to the White House. He'll be entering at 4 p.m., so just a few hours after Trump has this reciprocal tariff press conference. And we've already seen countries like India, which would likely be on this list when you look at the trade-weighted average of tariffs of imports going into India. 10% India taxes those, while coming into the United States, it's 2.5%. They're already having concessions. This morning, the energy minister of India is talking about more liquefied natural gas imports they want to take in from the U.S. You already see India thinking about potentially cutting their tariff rate when it comes to U.S. imports. So this potentially is going to mean weeks of concessions. But this is an administration that is in the mood to keep using this term reciprocity when it comes to trading partners.
Anne-Marie, I wonder if Trump has car makers in his sights because, you know, you've been following him for his whole career, political career, and how often does he mention the fact that there are no U.S. cars sold in Germany, at least in his view, and there's so many German cars sold here in the U.S. Jim Farley yesterday was saying tariffs will blow a hole in the U.S. auto industry, but the EU has 10% tariffs and has had for years on passenger vehicles out of the U.S., and we only have 2.5% tariffs on passenger vehicles out of the EU.
It's a huge gap that almost always gets the president's attention. He has complained about this. It's one of his biggest pet peeves when it comes to the European Union, especially when it comes to Germany. Angela Merkel, the former chancellor of Germany, who was in charge during Trump 1.0, talked about it in her book, how he would complain that there wasn't enough Fords, you know, in Berlin or Munich, but there were a lot of Mercedes and BMWs on the streets of New York. So if you're going to look at potentially what we could see from this administration, whether it's India, Brazil, reciprocal tariffs in the European Union, the auto sector for the EU, and potentially as well a big gap when it comes to agricultural products, the farm sector, that is going to come in focus. What happens after this, though? What's the scope of this? We should also note that it's really hard to do line by line, country by country in a massive EO. Potentially, Trump will punt this to his incoming trade ambassador, Jamieson Greer, who's not yet confirmed.
All right, well, stay tuned. Of course, that press conference coming up at 1 p.m. Eastern today. Bloomberg's Anne-Marie Hordern, really appreciate it. Let's keep this conversation going now with Jim Caron. He is Morgan Stanley Investment Management CIO and Cross Asset Solutions. Jim, great to see you at the desk.
See you.
So if you had told me that we would get hotter than expected CPI, that would be followed by hotter than expected PPI and renewed tariff threats, I would be pretty surprised to see the bond market rallying alongside stock futures. What do you think is in the driver's seat right now?
So, well, first, thanks for allowing me to be here and try to explain all this. So I would say that, look, there's a lot to unpack. There's a couple of things that are going on. Yes, the inflation numbers were hotter than expected. January tends to be a very seasonal month. It can be very, very technical. So I wouldn't take January as your starting point of a new trend. I think the market understands that a little bit and is walking some of that back. on the tariff component of things for inflation, we have to ask that question, are tariffs inflationary? And the answer is not as simple as a yes or no. It's yes, they are inflationary if there's an equivalent monetary offset, meaning if there's an easing of policy to print more money to pay for higher goods, then it's inflationary. If there's not, then it's just a shift in terms of trade. You get substitution effects, and it could be disinflationary as well. Now, Janet Yellen has said that, Powell has said that, even Larry Summers has said that. This is not new news. The other aspect is what really
Those are three people that Trump might not necessarily want to be on the same page with, right?
Correct.
I mean, did Elizabeth Warren say it too?
Well, that I don't know. But what I'll say, though, also is that the main driver for inflation, this is what I think part of the story that the market's missing, is it's actually government spending. Government spending is the main source of inflation because the government prints the money to get, to effectively more money chasing too few goods. And essentially what we've seen from fiscal year October 1st up until today versus a year ago, fiscal spending is up 15% when you're running nominal GDP in the U.S. around 5.5%. Fiscal policy has been, in the previous administration, very, very easy. A lot of money has come through. What Trump is also doing is he's trying to reduce that fiscal spending as well and bring down the inflation. So there's a lot of offsetting forces here, and that's what's helping bring down, I think, bond yields.
Do you buy it, I suppose? Because you have, at the same time, we talked about this yesterday, House Republicans putting kind of that opening offer on the budget deficit, the debt ceiling, to be raised by $4 trillion, which, as we pointed out, is larger than the GDP of France and many other large countries. So if that's the case, how does that really conflict with what you're seeing with DOGE and the actual efforts to try to bring down those costs?
So this is where we get into the fuzzy math of budget math, right? Somebody has to explain this to me at some point or another. But yeah, so overall, there's a net increase in the deficit in the 2025 to 2034 period, that 10-year period that the CBO scores, of about $3.3 trillion net. That number is lower than what it was in the previous administration over the same 10-year period, effectively. So on net terms, it's viewed as a net reduction in actual spending. But in absolute terms, it is an increase in the deficit. Sounds like I'm speaking out of both sides of my mouth. That's what budget math actually does, and that's going to really affect Treasury supply and everything else in the money creation.
You know, we had Kevin Hassett on yesterday, which was fantastic, and I was asking him about lowering aggregate demand. That's something he said a couple times on CNBC. He sort of walked that back, but you talk about cutting fiscal spending. Is that the same thing? I mean, are we going to see a slowdown in the growth trajectory if the federal government isn't throwing trillions of dollars at this economy?
So there's two sides to this, right? You've got the public sector and you've got the private sector, right? Those are the only two halves that we have here. So the more the public sector spends, the less the private sector can spend. The less the public sector spends, the more the private, right? So effectively, there's a shift in the balance here. So if the private sector takes on more of the growth creation, the government doesn't crowd out the private sector, then effectively you can have higher productive growth. And I think that's what's happening in the equity markets right now. What the equity markets are seeing is, okay, yes, there's a lot of noise around all of this, but is it on net, on balance, positive for U.S. companies, positive for U.S. earnings? Does this mean that U.S. companies have better and more ability to trade outside of the U.S. and exports and things like that? Is that on balance a net positive? That's what the market's trying to figure out right now. Yeah, there might be a little bit higher inflation. I think there will be. I think we're going to run in the high twos. I mean, I don't think we're going to 2% target inflation anytime soon. But on net, it seems like a positive for U.S. companies at this point.
Jim, I have a curveball for you. I promise it's somewhat related to what we're talking about, but there was a really interesting paper out from DoubleLine this month. It's a thought experiment basically asking the question, are you safer off buying Microsoft debt than you are buying U.S. Treasuries at this point? You think about the U.S. position as a borrower. Of course, it's covering interest costs is a big question. Ratings are going down, and we've been in a deficit since 2002. You compare that to Microsoft, of course, and it just has a stellar balance sheet. And I would love to hear your thoughts.
So, look, I mean, I think that U.S. government debt is the safest debt in the world. I mean, I know we can do apples to apples and compare the balance sheet of the U.S., which has a big deficit, relative to Microsoft, which probably has a surplus and is doing very, very well. That's really an apples to oranges comparison. I mean, the U.S. has a huge tax base. You know, it can print money when it needs to. It can pay its taxes. Has great growth potential. I don't see it as an even trade. In other words, so yes, I mean there are corporations with better looking balance sheets than the U.S. government, but at the end of the day, when there's a safe haven flight to quality, if something happens in the world, am I going to go buy Microsoft bonds or am I going to buy U.S. Treasuries?
Yeah.
I think I know the answer. I'm buying U.S. Treasuries.
To that end, how much do you buy? Because you look at the 10-year and that fluctuation that we really started on here, what's the upper bound? Do you think that there's more sell-off before you see a stabilization?
I do. I think that it's very possible that we see a 5% 10-year note this year, and I'd even go so far as to say in the 5 to 5.25% range. Now, how I get there is this. I don't think the Fed is going to cut interest rates anymore this year, right? So if the Fed funds rate is 4.5%, and let's say the 2 year sits right on top of that at 4.5% yield, the normal spread of the yield curve is somewhere between 50 and 75 basis points, 2 year to 10 year. So that would tell me that the 10 year could sit between 5 and 5.25. Now, the question then becomes, does that break the market? I don't think it does. I think that the equity market doesn't like when yields are rising, but once they stabilize around that level, I don't view that as destructive for equities, given the kind of growth that we're getting, the jobs market, consumption, and everything else. I think we can sustain a 5% 10-year yield. So it'll be painful on the way up, but once we settle there, bonds will actually look more attractive. So I'm okay with that.
You were bold enough to make the call. A lot of people were not. And
you were the perfect guest to have, the perfect cross-asset guest to answer the news questions of the day for us, Jim. Really appreciate you coming by. CIO of Cross-Asset Solutions at Morgan Stanley Investment Management. Coming up, another challenging year for Deere. The ag giant sees annual net income dropping 50% in its most recent quarter. Sales dropping 30% in this country this year. Details next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it, on Bloomberg Technology.
It's incredibly aggressive, the timeline to manufacture the first phase of this site and then start production mid-2026. How big a factor was that timeline in Ohio's selection, Palmer?
It has to be this fast because we don't have time for business as usual. The types of threats that the United States is facing, that our allies around the world are facing, the fact that we are predicted to run out of munitions within the first 8 days of a potential conflict with China mean that we need to hyper-scale our manufacturing. We are on a path to being a publicly traded company. I think that's an important thing. I want us to be accessible to the American public. I think that it's good for people to be able to invest in American defense companies, not for them to just remain private forever. I'll take an ideological stand there. I think that is a good thing for the country. It's good for us. It's good for our customer. As for when that happens, it's hard to say.
Don't miss Bloomberg Technology, live every weekday.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Well, on the earnings front, Deere is maintaining its outlook as farmers grapple with higher costs for equipment and relatively low prices for grains. American farm income will rise this year for the first time since 2022, but that's mostly linked to government assistance. Deere said sales in the key North American market will be down about 30% this year. Let's discuss it all with Bloomberg Intelligence industrials analyst Christopher Cellino. And Chris, it's interesting because, I mean, it's pretty doom and gloom. And you're seeing, of course, the stock fall in the pre-market, but it's been doing really well on a year-to-date basis, on a 5-year basis. How do you explain what's going on with the fundamentals and how the stock is actually performing?
Yeah, we knew going into the quarter that this was going to be a pretty ugly print, but it came in even weaker than some of the most bearish expectations out there, and it was really across the board. You saw sales and margins miss in all businesses as they continue to underproduce retail demand to bring down those excess inventories. Now, like you mentioned, they did maintain their 2025 net income guidance, and it certainly appears that we're going to approach a cyclical trough this year, but the earnings don't appear fully de-risked yet. You have further softness in the large ag business. Currency headwinds are going to build throughout the year, and we still have this overhang or uncertainty around the trade environment. So there has been a lot of optimism over these past 3 to 6 months as the shares have outperformed that we're approaching this cyclical trough, but it certainly appears that there's still a little bit more downside risk in 25.
The main thing, it looks like, from these pictures, the main thing they need to build their products are steel and maybe aluminum a little bit. If the prices for those things go up 25%, is that a big problem for this company?
It's a headwind. One thing about Deere and really ag equipment in general is that they do command tremendous pricing power in the market. It's one of the few industries that really could still get positive price even in down markets. Even if you look at this past quarter, top line down 35%, earnings down, significantly. We still had pricing positive, albeit modest. So they do have the ability to pass that on, but no doubt it will be a headwind moving forward.
And I mean, looking forward into the future, the company, of course, is talking about its pipeline. It's been introducing high-tech equipment, plows, sprayers, mowers that can operate without a driver, which is pretty interesting. Chris, it just seems like they're trying to get this upgrade cycle started, similar to what we talk about when it comes to iPhones, for example. But I guess if farm incomes are struggling the way they have, that's pretty difficult to do.
Yeah, and you're starting to see the business model really evolve to more of this subscription, recurring revenue type businesses with a lot of these precision products, which we think, ultimately will help drive structurally higher margins as we move through the cycle. But yes, it's a very challenging farm backdrop now. Farmer incomes are still under tremendous pressure. There's really not a lot of visibility on export market access. So until we have better clarity on that front, I have a hard time seeing farmers go out now and spending on new machinery or new precision technologies.
Chris, we thank you so much for your analysis. That's Christopher Cellino from Bloomberg Intelligence. We're looking at another set of earnings this morning because, of course, a lot is moving under the hood. Hertz had lost $2.9 billion in 2024, but it has finished selling 30,000 electric vehicles after a sour bet on a fleet of plug-in cars had really hurt the shares. Another 10% lower. You have to understand, guys, that this is a stock that has been down 3 years in a row, and you have had it finally starting to rebound this year. It's erasing a lot of the year's gains already. Just in today's move, there's some other brighter stories.
It's fascinating. By the way, fascinating because this was a bet on Teslas, and one of the big problems was maintenance costs they found. And you typically think, I talk to our editor-in-chief emeritus, Matt Winkler, all the time about his Tesla products, and he's always so happy that he never has to do maintenance on them. So I always wonder, what was the problem with Hertz?
I don't know, but obviously a lot went wrong there. It's been a roller coaster. Let's talk about Crocs, though, because Crocs is a fascinating story, adding, 30% today, of course, surging after its full-year profit outlook topped estimates. We were just talking about the 5-year track record of Deere. Crocs, though, up 130% over the past 5 years, probably with a little bit more volatility. But
for some reason, it's the airport footwear of choice these days.
There you go. And
I don't know why.
Love it. They do. My niece is like 10 years old.
Yeah, but adults,
very cool.
You see adults flying in Crocs.
They're comfortable.
And lastly, guys, we're watching Cisco as well this morning. Of course, it's up about another 5%. That AI bet paying off for Cisco. We're going to talk about it more after the market open. You're going to want to stick with us for that. Of course, we're less than 4 minutes away to the opening bell. Stick with us. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Open Interest, a check on futures right now. And there's plenty of green on this screen, of course. I couldn't tell you why, because we got hotter than expected PPI. We're going to get a reciprocal tariffs announcement at 1 p.m. But you can see the S&P 500 currently higher by about 0.2%. The NASDAQ 100, one better at 0.3%. The small caps flying this morning. The Russell 2000 up about 0.8%. It certainly helps that you have bonds rallying as well. And we're just sort of clawing back the losses that we saw yesterday for the small caps and for the S&P 500 as well. Now, coming up, less than 4 minutes until the opening bell, we'll discuss the market moves with Nimra Kang of North Star Asset Management. That conversation up next. This is Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, it's the big day for reciprocal tariffs. Those will be out in 3.5 hours. In about 30 seconds, we're going to see the opening bell. S&P futures up 0.2%. Market not bothered by stronger than expected inflation numbers in the form of PPI or the reciprocal tariffs that we're expecting. NASDAQ futures up 0.3%. Russell futures doing even better, up 0.2%. You hear the opening bell. You can see the New York Stock Exchange, the National Association of Water Companies. That's an important resource, and they're celebrating their 130th anniversary there at the New York Stock Exchange. Down on the NASDAQ marketplace, SailPoint is celebrating its IPO. SAIL is the ticker. The company provides identity and access management solutions, and they'll be on with us next week. Right now, let's get over to Catherine Greifeld. She's got a look at the live trade for you. Katie?
Yeah, we are 34 seconds into this trading day, and like you said, unbothered is the name of the game. The S&P 500 up about 0.2%. Of course, we had a little bit of a choppy trade yesterday. It really feels like we've been going sideways for a while here, but at least for right now, the color is green, and you can extend that to the NASDAQ 100 as well, up about 0.3%. Small caps are your leader for right now. We know they got hit hard yesterday when we saw that 10-year Treasury yield peak above 4.6%. Bonds are rallying today, though, and so too are the small caps. We'll keep an eye on that one. But let's take a look under the hood right now and talk about Robinhood. Revenue more than doubled in the last quarter as it capitalized in election volatility and, of course, that Trump trade. It also saw crypto revenue jump by more than 700%. We'll discuss it all with CEO Vlad Tenev in 1 hour's time. Shanali, really looking forward to that conversation.
I want to talk here about another technology upstart as well. Reddit is down almost 7% as the market opens. User growth had disappointed in the previous quarter. It had been struggling to keep up with larger digital advertisers like Meta and Google. What's more is Reddit said that user growth slowed after Google made a change to its algorithm that impacted search traffic. Fun fact, Matt, Google had previously accounted for as much as 50% of traffic on certain days for Reddit. So it's a really big deal that that algo had changed. You see it in Reddit shares.
That makes a lot of sense. I Google stuff a lot, and I often see Reddit results on the first screen. Let's talk about John Deere, the tractor maker, of course. You can see right here down 5%. Although Katie points out, it's still doing pretty well.
It's crushing it.
Year to date, and yeah, absolutely crushing it. I think it's up more than 150% over the past 5 years. They've had a fantastic run, and it's a little bit
it's unintuitive.
It's
because the fundamentals, I mean, it's pretty doom and gloom. We talked to the analysts about it. But I mean, even year to date, through yesterday's close, they were up about 12.5% year to date, far outperforming the benchmarks. A little bit of dose of reality right now.
Tariffs be damned.
Yeah. Well, that's the uncertainty, isn't it? But what's interesting to me is the analyst saying from Bloomberg Intelligence that, yes, you might see a trough this year, but more uncertainty until you finally meet that trough.
All right. Let's talk about the man who can end that uncertainty for us, and that is President Donald J. Trump. He has vowed reciprocal tariffs today without giving specifics yet. Are we going to get at 1 o'clock?
1 p.m.
1 p.m. is when we're going to. Okay, let's take a look at the winners and losers of the current trade war with Bloomberg's Bailey Lipschultz. Did I set that up right? Because I see in the prompter you have Deere as a loser, although Deere.
Well, stock's down today.
Okay, just for the day.
In uncertainty about what tariffs can mean. Yeah, partly, you know, I blame the producers. No, I'm just kidding. But it is really driven by the uncertainty around.
Will Shaker.
Exactly, Will Shaker. Appreciate you. But when you look at really under the hood, you guys are mentioning the uncertainty for farmers. The uncertainty for Deere is how much they source from China. When you look at on the terminal using the supply chain function, about 7% of their products come from or they're sourced from China. That obviously will impact the underlying business. So when you're seeing this potential tit for tat tariffs being rolled out later today by Donald J. Trump, hopefully with some kind of insight. That's why you're seeing shares down lower. Also, keep an eye on Coca-Cola. Stock has been trading higher over the last few sessions. Company, though, according to Washington Post, maybe is going to make more products in plastic bottles, so shifting away from aluminum. And then another name that we're keeping an eye on.
That's not a very good idea.
It's also not good
What do you
for the
think happens
environment.
to those plastic bottles?
Oh,
They go in the ocean. It's fine.
They end up in the ocean in Indonesia. That's not cool.
Well, is anything really cool?
Those are big external costs.
Everything, of course, is subjective. But tell me about Shark Ninja, because we have a fascinating story on the Bloomberg terminal about it today.
Yeah, Katrina Campoli, Bloomberg reporter on my team, reporting that the company is really focusing on bringing their supply chain away from China, focusing in Southeast Asia, markets like Vietnam, to help produce those products. Their actual vision by the end of the year is to really be completely out of China, and saying that there's no supply chain in the U.S. for those blenders. They're not doing anything here, but really pushing away from China into other countries with the hope and the expectation that they will avoid the wrath of Donald Trump.
Yeah, and you see the shares rising on earnings day. But we've had this conversation with the CEO on this program that even with this, push to bring manufacturing back to America, there's certain industries that just don't exist here. So
yeah,
there's
and
limits.
won't exist, right?
Exactly.
He has said, and we've talked to other CEOs. I think Brooks, the shoemaker, was saying the same thing.
Right.
They're not. Like, it doesn't matter if tariffs are 100%. They're not going to bring that production back to the U.S.
And frankly, the trade deficit is steeper nowhere else than with China, and that's kind of the elephant in the room here. Closing that gap would take a lot. There are winners here, though, as this is all being sorted out. One question is how much more room gold has still to run.
Well, uncertainty there, but obviously the flight to real gold, not digital gold, has been playing out. Spot gold up more than 46% in the last 12 months. That's beating the S&P 500. Another area we're keeping an eye on are dividend stocks. When you look at the iShares ETF, ticker DVY, total return over 12 months, barely trailing the S&P 500 and the NASDAQ 100, despite all of the expectations around AI. So you are seeing other pockets of the market, a flight to safety continuing to play out, just given if you're trying to outperform and you're seeing maybe the S&P 500 equal weight index getting a bit of a bid, trying to find other areas.
Can I just ask, when you talk to investors, do they assume that these steel tariffs, scheduled, I think, for March 12th, are actually going to go into play? I mean,
the people I talk to view tariffs as a bargaining tool, and they think that the dates are going to continue to be pushed off. But if you're investing and managing a book actively, you have to at least have some form of kind of value placed on what the president is saying. And that's why you see some of these sharp moves when you look at what we saw recently with U.S. Steel and other steel makers, aluminum companies, because there is that uncertainty. And whether you were short the stocks and are covering those positions or just trying to scale into a position on the expectation that maybe they do come to fruition. But I do think, at least from my conversations, I don't know about you guys, it still is seen kind of as a bargaining chip that Donald Trump uses to eventually kind of lower expectations and chalk up some form of a win.
Well, let's ask an investor that right now. Bailey Lipschultz, really jack of all trades. Appreciate your time. Let's keep the conversation going with Nimrit Kang. She is North Star Asset Management Chief Investment Officer. And Nimrit, weigh in here. I mean, the consensus out there seems to be that these tariffs, these threats that we get, seem to be negotiating chips for Donald Trump. But as an investor, how are you viewing them? How do you respond to them, if at all?
Today's market reaction would tell you that the market is really thinking that these are nothing more than negotiating tactics at this point. The reaction is, yeah, we've seen it. There isn't much room here on the CPI, PPI, and inflation's already running hot, not much to do there. For us, we are in this period of extreme political regulatory disruption. And that's on top of what we're used to living with, which is the technological disruption, all related to AI. And our playbook in this kind of environment, Katie, is really to think a bit long-term, stay diversified, use very prudent risk management to exit out of positions, get into positions, manage position sizes, and diversification. When we're talking about diversification across business models, market cap, and also on the margin going international.
I wonder, GDP growth is a positive right now, and does that change? I mean, earnings growth expectations seem to be coming down. Consensus at the end of last year was 14% for the S&P 500. David Kostin came on earlier this week and said 11%. I see you're looking at around 10%. Does that continue to come down? And do GDP expectations also start to come down, especially if this administration gets to cut as much spending as it wants?
Yeah, Matt, the tricky part is we don't really know the long-term impacts of how the DOGE actions flow through. You know, it's one of those moments where until COVID-19 happened, we didn't really know how linked our supply chains were on a global point of view. And we feel it's kind of a similar situation here. Government is a big customer, and government employees are big consumers at the end of the day. So, you know, when we think about where we are, this radical action on cutting different government agencies, reducing that, we don't really know how that feeds into different parts of the economy, how different businesses are impacted. And that's where we think there's a lot of cautiousness baked into. I listened to a number of earnings calls this earnings season, and especially interestingly for industrials, which you would think would be big beneficiary of reshoring, there was a lot of trepidation, a lot of cautiousness, a lot of back-end loaded guidance. Yes, we're going to look into the earnings growth, but it's not going to come until second half. And that's because we don't really know how these actions flow through to the real economy.
Speaking of the real economy, today's trade is set up in an interesting manner. I think it says something about the story under the surface. You do have the S&P 500 really erasing the morning's gains already, but what's leading it higher, to the extent it's being led higher, is consumer discretionary. And in this earnings season, you have seen some promising information come out of big consumer companies. Today, it's the likes of MGM. We've seen good news out of travel stocks. How strong is the consumer? Do you think that we can sit here in the middle of 2025, later this year, and be fooled by the strength that we're seeing today? Is this a fading phenomenon?
It's definitely a two-tiered economy. I mean, when you listen to these companies, they're definitely calling that out. We heard that in McDonald's. The lower-end consumer is not spending as much. They're a lot more cautious. They're not in that strong financial position. Where the spending is going on, especially when you relate to travel and some of the experience, is coming from the experience economy. It's coming from that aging demographic, seniors who have a lot more in their retirement accounts with the strength we've seen in the financial markets over the last few years, and just overall savings. Now, the question, Shonali, gets back again to this, which is all these actions that coming out of the Washington, D.C., how does that play into and impact the lower-end consumer? And at what point this lower-end consumer already feeling the pain it becomes too much, and that becomes a magnitude where it starts to impact other segments and other business as well. We don't know yet. It's too early to tell, but it's definitely something that gives us a lot of caution. And we do think that we're not in that position where, the consumer is flourishing by any means. Yes, pockets of it, consumers are, but not in aggregate.
All right, Nimrit, great having you on the show. Thanks, and I hope you can come back soon. Nimrit Kang there of North Star Asset Management. Just looking at the dollar index, it's so weird to see it down. Well,
Yeah.
it was in the...
That helps.
It made a U of our J screen there. All right, coming up, Cisco shares soar, Reddit in the red. We'll take a look at what both tech companies can expect next. This is Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture. It's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning, and we start with Gordon Haskett saying that Target is no longer a buy. The analyst says that the uncertainty around tariffs and interest rates will weigh on its outlook, also downgrading Macy's for that same reason. Next up, DZ Bank is upgrading Coca-Cola to a buy after it beat on profit expectations. Coca-Cola has been largely unscathed, even as budget-conscious shoppers pull back on supermarket purchases. And finally, we have Cisco getting raised to a buy over at Rosenblatt Securities, the networking equipment company boosting its full-year revenue guidance. Also, the analyst citing its AI potential. Shares currently up about 3%.
All right, let's get some more on Cisco right now. We're joined here at the desk by Mandeep Singh. He's a senior technology analyst at Bloomberg Intelligence. And Mandeep, talk to me first about, for those of us who remember the dot-com bubble, right? How has this company changed from a maker of routers that, you know, enables the internet to a company that hopefully can ride the AI wave going forward?
Yeah, I mean, look, they've made a bunch of acquisitions along the way, some big ones. The most recent one was Splunk, and they have branched into software more and more. But in this case, I mean, the guide and, you know, the revenue raise was more around networking, and it's consistent with what we have heard from hyperscalers this quarter around raising their CapEx guide. So it's clearly trickling down to all the suppliers of that gear, I mean, beyond NVIDIA. And look, I mean, I would say Cisco is still not the bellwether it used to be. So even though, you know, we saw a clear beat and raise, I would still look up to NVIDIA to kind of tell us the true picture around what the AI potential is going to look like for this year.
One other potential problem for Cisco is the government spending aspect of this. If you have the government planning on spending less generally, is that going to be a problem for Cisco when networking is such a big part of their story?
It could be. I mean, but when I look at, you know, some of the projects that are impacted by DOGE, I don't really think it's going to trickle down to networking that soon. And given AI is a high priority, I would be surprised if, you know, a company like Cisco gets impacted.
So Cisco shares having a good day. I want to talk about Reddit, though. I've been a power user of Reddit since about 2011. It's had a fantastic run since its IPO, up more than 400, nearly 500%, but coming back to reality a little bit today. It seems like user growth not exactly impressing.
Yeah, especially anytime you're an internet company that misses on your daily active users, that is never good in terms of stock reaction. But look, they're walking a very tightrope here because a lot of these LLM companies are using their data to train their models, and the chatbots are answering a lot of questions based on Reddit data. So it's in this case, Google just made a slight tweak to their algorithm. That ended up impacting the traffic that was going to Reddit. So I think that's where, yes, the kind of the data sales is a positive, but then if the traffic gets impacted, it's going to hurt the user metrics. And they are reliant on Google for almost 40% of their user traffic.
And by the way, ChatGPT isn't sending you to Reddit the way Google does.
No.
So the future doesn't look bright for that. For that use case.
For what it's worth, we are still more than $40 above where it was trading on its first day of trading. So still a darling, but little change for Google, big change for Reddit. Mandeep, thank you so much for joining us. That is Mandeep Singh of Bloomberg Intelligence. We're going to have more on Reddit with the company's COO, Jen Wong, on Bloomberg Technology at 11 a.m. New York time. Now stick with us. Up next, the Wall Street Beat. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to Open Interest. Taking a look at stocks right now. Of course, the S&P 500 briefly erased gains. Now we're back in the green, but those pre-market gains that we were looking at coming in a little bit. The S&P 500 still up about 0.1%, 0.3% if you take a look at big tech faring a little bit better here. And the Russell 2000, the small cap, still hanging on to that lead, though it's diminishing slightly, but the Russell 2000 currently higher by about 0.5%.
And it's time now for the Wall Street Beat. QRT, a London-based hedge fund spun off from Credit Suisse, is emerging as a powerhouse in the hedge fund industry. The fund has gone from $800 million to more than $23 billion in 7 years. And it's a rarity to see that kind of growth in the $4.5 trillion hedge fund industry. Bloomberg's Nishant Kumar reported on this secretive hedge fund. He joins us now. One aspect of this that I find the most stunning is the culture, because this has been an era of star hedge fund traders, $50 million payout packages. And in this case, you see a shunning of that star culture. Why do we see that, and is it working? Does it set a standard for the future?
Well, it's a more collaborative culture. That's how the company was conceived and has progressed. It's all about team, not individuals. Payouts are not linked to, it is linked to your performance, but it's not that you will be getting a certain percentage of performance, which is the standard at pod shop, what we call pod shops. So QRT is kind of a multi-strat which invests and performs like other multi-strats, but it's not siloed and we cannot call it a pod shop.
I love this story, Nishant, and I mean, the first paragraph, under a low gray sky, a building site sits exposed amid the barren beauty of Iceland in winter. You got to think about writing a novel, honestly. But this...
On hedge funds, yes.
On hedge funds, exactly. Well, secretive hedge fund gets my attention too. Why secretive?
Well, that's how, they have grown. They were part of Credit Suisse. And there also few people know about them. So they were not talked about, not discussed. And potentially because they were insanely successful within Credit Suisse as well. So you don't want your secret sauce, you don't want your best performers to be exposed to the market. And they have maintained that culture. The same team, the same 14 partners who started the firm are still there at the firm. The same 5 largest backers of the hedge funds are still loyal. They have topped up their capital, their cash to the hedge funds. So, they have never kind of needed to advertise themselves. They have grown quietly and big, very big. I mean, this must be the least known large hedge fund in the world right now.
Well, Nishant, to that point, I mean, you talk about this rapid rise to the top 1% from the unknown. It's rewriting the narrative here. How often do we see someone just take off like this? Is this a rarity?
Very, very unlikely. I mean, it's fast and furious. I cannot think of another firm which has grown so quick, so fast, and so big in the hedge fund industry. And we have to also see in what kind of environment. Over the last 10 years, we have seen large hedge funds getting bigger. The likes of Millennium, Citadel, D. Shaw, really dominating the market. They have hoovered away every person that can be hired, and they are looking for more. They have convinced people who wanted to start their own hedge funds not to do that and join them. I'll go a step further. I mean, they have persuaded people who ran their successful hedge funds to shut that down and join them. And in this environment, there is a player which has grown so fast, so big, with 1,400 people. That's quite rare.
Nishant, great story, among the most read on the Bloomberg as well. Bloomberg's Nishant Kumar talking about QRT. Coming up next hour, Kathy Bonjanchik joins us. This is Bloomberg.
Offers before to take over Greyhound, but then in the middle of the pandemic 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically. And think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority bus terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The heavy rain has begun in Southern California, and it's triggering fears of new dangers after last month's deadly wildfires.
Los Angeles got drenched overnight. This storm is living up to the forecast, and this isn't even the worst of it. The heaviest rain is expected this afternoon, overnight, and into early Friday morning. Yesterday, there were evacuation warnings issued for areas prone to rock and mudslides, especially the burn zones in Altadena and the Pacific Palisades. Those warnings are expected to become evacuation orders. Craig Figner for CBS News, Los Angeles.
German police say they've arrested an Afghan man after he allegedly drove a car into a union protest in Munich today, injuring at least 28 people, including children. World leaders gather for a meeting in Munich tomorrow, among them Vice President Vance and Ukrainian President Volodymyr Zelensky. Correspondent Holly Williams.
It is an annual conference, and it is regularly attended by some of the most significant and well-known political figures on the planet, and security in Munich will be appropriate to that. This attack occurred about a mile away from the conference venue, and at this point, we cannot confirm whether there's any connection between the two.
President Zelensky not pleased over news President Trump talked by phone by Russia's Vladimir Putin about a possible plan to end the war in Ukraine without including him. Zelensky says he will not accept any agreement that doesn't include Ukraine in the conversation. The Senate is expected to meet this hour to hold a final vote on confirming Robert F. Kennedy Jr. as Health and Human Services Secretary. CBS's Christina Corujo says he's overcome some key opposition.
One of them was Senator Lisa Murkowski from Alaska. She said that she is going to support Kennedy amid still some concerns of his position on vaccines. Susan Collins from Maine is also supporting RFK Jr., so he's definitely en route to being confirmed.
A federal judge has given the green light for President Trump to proceed with his buyout plans for tens of thousands of government workers. Correspondent Ed O'Keefe is at the White House.
The Trump administration has warned those millions of federal employees who didn't take the offer that they aren't guaranteed a job. And last night, for example, CBS News confirmed mass firings have begun at the Education Department, where some who were hired most recently were sent letters informing them they've been fired from their job, effective immediately.
The Dow's up 38 in early trading. This is CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Reciprocal Tariff Day, apparently. Come 1 o'clock, I'm Alex Steele alongside Norma Linda. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We have a great hour lined up for you. We get you covered on all fronts when it comes to tariffs, from the economic side as well as from the commodity side. Dan Pickering is actually in the house. He's Chief Investment Officer at Pickering Energy Partners. He's one of the best in the energy industry, so lots to talk to him about. Ellen Hazen will also be joining us from FL Putnam Investments to talk through the market reaction. How do you manage this volatility and uncertainty, or do you really need to? Plus, Mark McLean is CEO of SailPoint Technologies. The company's IPO'd yesterday. We'll get more of an update on that company as well. But in the meantime, let's get you caught up with news and the business flashing with John Tucker.
The business flashing being brought to you by IBKR. Will the percentage of the U.S. experiencing drought conditions exceed 18% on February 18th of 2025? At IBKR Forecast Trader, the yes was recently at 35%. What's your take? Trade your prediction at ibkr.com/forecast. 10 of the 11 major industry groups in the S&P 500 higher right now, led by consumer discretionary and materials. Wholesale prices rising in January. Another inflation report today was more than forecast. Higher food and energy costs. Stocks higher, yields lower. Why? Well, several of the PPI components, they actually feed into the Federal Reserve's preferred inflation measure, the PCE. Those categories, they were more favorable in January, registering declines in most healthcare items and airfares. President Trump says he's going to announce reciprocal tariffs today. Expect that around 1 p.m. Eastern. Still waiting for details. Well, investors wait for the latest salvo in the trade war. Seema Shah, Principal Global Investors, worries companies will pull back on spending and investment.
It weighs on global capex, and I think that's one of the key things here is, we make an announcement today, but how long it stays, what else, is it going to be increased at some point? That kind of uncertainty is really what does weigh on global capex, and that's what actually can be more damaging.
S&P 500 up 13 points, a rise of 0.2%, 65 in the index. The Dow up 52 points, NASDAQ 100 97 points higher. 2-year yield 4 basis points lower, 431. The 10-year down almost 7 basis points at 455. Earnings, Deere anticipates another challenging year. Those shares right now down 3.2%. And ahead of Valentine's Day tomorrow, we have to do earnings from a company that was founded on love.
And?
That company? Anybody?
I said Victoria's Secret. You said
Anybody
no.
want to guess? Cisco.
Okay.
What?
They delivered an upbeat sales forecast for the current quarter. Company raising its fiscal 2025 target. Cisco shares up 1% right now. Back in the day, this was at Stanford University. Two folks, Leonard and Sandy, they wanted a way to send love messages over their computers. So they got out these long wires and they strung them actually through the sewers at Stanford so they could send love messages to each other.
The more you know.
Oh my God, I love this story.
Timely during Valentine's
Leonard Bossack and Sandy Lerner, and they eventually got married. Today they're divorced. That's today's love story.
Wait, where did you find this info?
Sebastian Mallaby wrote a great book, The Power Law. I recommend. It's very accessible. It's about Silicon Valley, financing, et cetera, so forth. But he does a beautiful job of reporting in this book, and that's one of the stories about Cisco that he tackles.
Amazing.
Read that book. It's very good.
And this is one of the reasons why I appreciate John Tucker. Thank you very much.
Just one.
News you can use.
I said one of the. There's
Okay.
definitely more. All right, Alex Steele here alongside Norma Linda. So, it feels like we're just going to wait now, right? We got to wait and see what happens at 1 o'clock. ...
How do you manage that?
Definitely a waiting game. Honestly, my eyes, and I'm keeping an eye on the market. I don't even know which direction we're going. Yesterday we were down. Today we're up. There's so much volatility baked into the market right now, especially with tariff concerns. You've got the Fed in focus. We've got data nonstop. There's really so many things to keep an eye on here as an investor.
Except the VIX is under 16, so that's a head scratcher for me too. Isabel Lee is joining us, Bloomberg Crosshouse, a reporter, going to dig through some of the individual names. What are you looking at today?
Crocs, it's up 17, so we have shares climbing after the company reported sales and profits at top expectations. They also issued a stronger than forecast annual forecast for both metrics. So, I mean, I guess people still wear Crocs. I mean, I don't, but it also said that
doesn't surprise me.
Strong international sales and digital channels really drove the company's earnings. So overall, the quarter was solid.
So Crocs are still in.
Yes, but they also own Hey Dude, and I had to look up what Hey Dude is.
What is Hey Dude?
It's footwear.
It's super popular now, right?
Yes, I'm
Clearly
sure.
not for us. A glowing endorsement from Isabel Lee.
But Bloomberg Intelligence said that the overall results highlight that Hey Dude's recovery may need more time because of inflecting to the growth in the direct-to-consumer channel in this quarter, etc. But overall, it's a good report for Crocs.
I had a quick search. They look very comfortable.
There you go.
I mean, Crocs is the epitome of comfort.
This
I
is
mean,
true.
Unless you have plantar fasciitis, and then you can't wear them like I do.
My mom has that.
And yeah, I know. Yeah, we're old here. Okay, next, what else are you watching?
Robinhood. Shares are jumping 13% at the open, so this is the most since November, and it was a beat across the board. Net revenue was a beat, transaction-based revenue, crypto revenue, assets under custody, net deposits, everything basically exceeded expectations. And of course, this comes after this whole crypto frenzy leading up to the presidential election, and even beyond that. So President Trump pledged to be the first pro-crypto president, and he has so far lived up to that. And this marks also the 5 sequential quarters of positive net income for Robinhood. So it's just kind of, it's astonishing how they used to focus on meme stock, and now they're a $50 billion firm.
Insane.
Can you believe it?
And they want to get into maybe sports betting too. That's a TBD,
Yes,
right?
Definitely.
yes.
Which could be a big one.
They were challenged with that. We don't know the outcome yet, but it just shows their nimbleness. They saw that was the next big thing. They had Super Bowl specifically in mind. So
no, fair enough. Okay, last up. What else you got?
Trade Desk. This isn't such a great story because shares are sinking by around 32%. That is a record. So this came after the company gave a first quarter forecast that is weaker than expected. They reported fourth quarter results, and they actually said that they were disappointed that they fell short of their own expectations. So if the company admits that, then you can expect shares to fall at a record low. At Trade Desk, for those who don't know, is an advertising tech company. And we have the likes of Evercore downgrading it, saying that, yes, track record and fundamentals have been consistent, but now we have a fundamental correction in our hands. And basically a lot like Susquehanna, Wedbush, JPM, Stifel, Guggenheim, they all downgraded.
Real sour.
Trade Desk.
All right. Thanks a lot, Isabel. Appreciate it. Isabel Lee, Bloomberg Equities reporter. So apparently, guys, Sam in our radio booth is talking about dog Crocs. So these are Crocs
them up.
that you put on your dog.
And they're so cute.
They're so cute. And then you can match your dog's Crocs with your Crocs into one beautiful Croc.
Though I'm curious how much they're priced for, because you'd have to buy 4.
They probably come in like
They have to
bunches.
come in a set, a set of 4 for your 2.
Of course. And then if you replace one, maybe you can mix and match. Anyway.
Right.
That is our news you can use on this Thursday. All right, we are waiting, though, for the main event, which comes at 1 p.m., and that is from President Trump and what these reciprocal tariffs are going to look like. Enda Kern is Bloomberg Global Economy reporter joining us. What is the base case of what we can expect?
Well, it's certainly going to be a big headline announcement. The president is expected to detail reciprocal tariffs on trading partners around the world. In essence, this will be essentially an effort to level up tariffs between the U.S. and trading partners, as the president said himself the other day. If you make us pay, we'll make you. If they charge us, we charge them, was his exact sentence. Now, that's the headline, Alex. There's going to be a lot of technical detail on this that we don't yet know. We don't know which products will these tariffs be levied on, what levels, when will they be implemented, how will they be implemented. I mean, it's listening to experts on this, trade experts. Is going to be considerable amount of technical work involved in getting this process off the ground. So it might be today that we have the big announcement setting out the roadmap for this. But I think we'll be surprised if these were effective immediately, but we'll have to see what the details are.
How are people around Washington dealing with the lack of clarity and what the potential impacts could be for the economy?
Well, I think certainly, I mean, it's curious because obviously on the one hand, the president was elected with a mandate to implement tariffs on goods, both from China and around the world. That was one of his big campaign planks, so there's no surprise there. I think the speed of the move, speed of the trade move has surprised people. The fact that some of the top trade officials aren't actually yet finally confirmed, even if they're expected to be, they're just not yet in their offices. And then, you know, the threats against Canada and Mexico, the quick move on China, and now we're going to have this reciprocal. So it's all moving, I think, somewhat faster than people expected. Nonetheless, there, you know, obviously a lot of division over what this means. You have business people saying it does cause uncertainty for them. It will drive up their costs, and they will need to pass along those costs to consumers. The Trump administration and those who defend this trade policy say it's important. It's a very important tool for protecting U.S. businesses who are exposed to, say, cheap competition from China in particular. And of course, the president says it raises revenue and will drive investment here as well. So opinions on this are divided quite sharply. But I would say that for most observers, regardless of what side they're on, things are moving probably faster than expected, I think.
So when we talk about you tariff us, we tariff you, based on that calculus, what countries are most in the crosshair today?
I mean, it's going to be probably everyone, Alex. In particular today, it will be interesting because just keep an eye on India, because the Indian leader Modi is here for a meeting with President Trump, and India does have a lot of tariff barriers and other barriers on doing trade with it, including on U.S. goods. Now, they have taken steps in recent weeks to bring down some of those barriers, and they're looking to, in terms of against the U.S. imports. So right here, right now, India is obviously going to be one that's in the focus, given the two leaders are meeting in the White House. But beyond that, I think you're talking about all trading partners around the world. The president has said he wouldn't make exceptions or carve-outs for anyone. There was a hint of a carve-out perhaps for Australia on steel. But other than that, Alex, I think if this process goes ahead the way the president is describing, it's going to be a leveling up of tariffs against everyone in the months and years ahead.
What about some of our allies? How are our allies responding to this? I know we've had global leaders saying that they may go toe-to-toe with Trump's tariffs. What does that mean for our relationship there?
It's kind of going two ways. So on the one hand, you have the head of governments of trading partners around the world, first of all, making conciliatory noises. I mean, the EU, for example, have said, look, we're willing to buy more LNG. They've put that out there. You've had one of the Chinese top leadership at Davos make the point that we're willing to import more goods. They didn't explicitly say the US, but that was the suggestion. And of course, Mexico and Canada put those troops on the border and made those other offers to the president. So I think this kind of reaction function has been, where can we do business, how can we sort this out? But to your point, there is also the option to retaliate. The EU has made clear they will respond in kind. They have a list of US imports and goods and services they would want to target in response to any US measures. Mm-hmm. China has already retaliated with goods and antitrust investigations on her. So it's kind of on the one hand, countries are saying, where can we do business? But on the other, they're saying, okay, well, two can play that game.
All right, Enda, gotta leave it there. Thank you so very much. Enda Curran, global economy reporter, joining us. Coming up, we'll continue the conversation on tariffs as well as economic data. Michael McKee will be joining us to break down the recent PPI, plus Dan Pickering, one of the best in the oil industry from Pickering Energy Partners, in studio to talk about oil. This is Bloomberg Intelligence.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash, and we are being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Stocks are higher, yields are lower. S&P 500 up 28 points, up 0.5%, 6,080 on the index. The Dow Jones Industrial Average up 94 points. That's a rise of 0.2%. The Nasdaq 100 right now 181 points higher, up 0.8%. The 2-year yield down almost 4 basis points, 431. The 10-year is down almost 7 basis points, 454. This after another inflation report. The Producer Price Index rising 0.4% in January, reflecting higher costs for food and energy. But Mike McKee will tell you, if you dig deeper into this report, the components of it feed into the Fed's preferred inflation gauge, they were actually better than hoped for. NVIDIA, Tesla, Intel, Eli Lilly, leaders in the S&P 500 in terms of index points right now. The best performing individual stock in the S&P 500, MGM Resorts, it is up close to 15%. The gaming and entertainment company reporting fourth quarter adjusted earnings per share coming in ahead of estimates. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Nora and Alex.
Well, thank you so much for that wonderful breakdown, John. I'm Nora Melinda. Happy Thursday. I'm here with Alex Steele, filling in for Paul Sweeney today. Stocks are in the green, as John was just mentioning. We've got the S&P 500 up about 0.5%, and the Nasdaq up 0.8% right now. We're seated here in the studio with the brilliant Michael McKee. He's international economics and policy correspondent, and he's here to help us break down some of that economic data that we've been getting, from PPI to initial jobless claims. But really, right now, on the minds of many investors is tariffs. My question for you, Mike, what is the legal basis for imposing this set of tariffs?
The president has a wide range of legal abilities to impose tariffs, which Congress has basically given him. Congress has the power, but has conceded it to the president. Section 201 of the Trade Act of 1974, to get really nerdy here, is what they use to impose tariffs on a lot of different issues like solar cells and washing machines and things like that back in the first Trump administration. That allows the president to put tariffs on imports to protect domestic industry, sort of a sector-wide thing. And then Section 232 is what they use for steel and aluminum tariffs. And those allow individual companies to complain about injury from imports, and then the USTR and the Commerce Department do an investigation. And if they find that there is harm to those U.S. companies, then the president can impose tariffs. And both of those things he's used again now that we're back in business. The question about what he does with reciprocal tariffs is very interesting, because maybe he can use the 201s because it's industries. It sort of depends on what he decides to do, because we don't know whether this is just going to be reciprocal tariffs on the average tariff that countries put on, or on individual tariffs themselves, like the tariffs the Europeans put on U.S. automobiles. But the easiest way for him to do it would be Section 338 of the Tariff Act of 1930, which allows any kind of tariffs up to 50% if a tariff practice from another country disadvantages a U.S. company. And it certainly would be easy to show that with unequal tariffs. There's only one problem with this one. And you got to watch this afternoon and see what their justification is. The Tariff Act of 1930 has another name. Most of us know it by another name. You want to guess?
No.
I'm so curious.
Smoot-Hawley.
Ah, okay.
So I can just see the headlines. President goes back to Smoot-Hawley tariffs.
I actually did know that. Now that I get the recesses of my brain back. And for those of you who don't know, Mike covered D.C. For decades, so this is really marring his two expertise. And he also covered the NAFTA renegotiation, the USMCA, et cetera. What do you think? What country do you think, based on all the legality part of it, is going to be most hit?
That depends on what how he decides to impose these. If it's an average tariff basis, it's going to be a country like India is got average tariffs of 11%, on a weighted basis 12%. The U.S. is between 2 and 3%, so there's a big disparity there. The U.S. is among the lowest in the world with tariffs, so a lot of areas could feel it in that area. Now the question is, does he do it on specific industries? There's something like in the tariff logs, there's something like 903,000 different potential targets if you want to get down to specifics. So that seems like it'd be pretty hard to do. Plus, then you get everybody asking for exceptions for this one or that one. And if you got to do 903,000 of them, you're never going to get the tariffs on.
Right. That's such a good point. The exemptions, right? We've already heard some potential metal exemptions from Australia, TBD on European car exemptions. All right, Mike, really appreciate you're going to be a busy man come 1 o'clock, so don't go far. Mike McKee, Bloomberg National Economics and Policy Correspondent. All right, one other asset class that's moving. Yes, it's definitely a tariff story, but it's also a potential end of war in Ukraine story, is oil. So oil prices are down by about 0.5%, but yesterday they got really kicked down the road, down by about 2.5% on a potential resolution to the conflict in Ukraine. So I wanted to dig more into this with Dan Pickering, Chief Investment Officer at Pickering Energy Partners, joining us here. Dan, it's just the main question, like, how are you guys looking at the oil price right now?
Alex.
That was a very pregnant pause there, yeah.
Yes, it was, because there are so many things happening.
I know.
So many variables, whether they're political, geopolitical, supply, demand. We got news today that the IEA, International Energy Agency, thinks that supply and demand is tightening. We have the risk of Iranian sanctions. We have a Russia conflict that, if it concludes, everyone's nervous that oil price goes lower because Russian production goes higher. So many variables. The way I think about it, supply and demand is generally sloppy, not particularly tight. The geopolitical stuff is keeping it a little bit tighter. And so I would take the current $71 WTI number for 2025. I'd put it in the bank if I could get it today.
So many things moving right now. Where would you say is the best outlook for energy investments this year? Gas, oil, services?
Great question, Nora. I think that natural gas is the area that's getting better. If you look particularly in the U.S., we have LNG exports that will rise about 5% of total U.S. demand between now and the end of next year, early 2027. And so the market's very optimistic that we'll see tightening supply and demand. Natural gas prices were in the 2s for most of 2024. They're in the high 3s right now. They're forecast to be in the 4s next year, could be 5s. And so natural gas is the hottest area. I would say services is probably, rig count is probably the weakest, because drill baby drill is not on the table.
Just to jump in here, more headlines coming out. This is also from CNBC, saying that President Trump's reciprocal tariffs will take effect some months later. So this is not a today story, just an announcement story today. Also another red headline here. Blue Origin is set to cut about 10% of its workforce. This is Jeff Bezos has backed Blue Origin. That's quite interesting, but said to cut about 10% of its workforce. Okay, Dan, there's a lot, like you said, to unpack. I do want to go. So, okay, last year at CERAWeek, and for those of you who don't know, CERAWeek is when all the energy nerds convene on Houston and they talk about energy for 5 days, and it's super awesome. The conversation was, look, you can only own one energy stock in your portfolio now, maybe 2 max. So like, you really got to pick the best of the best, and that led to some M&A. It also led to really the creme de la creme stocks doing better than everybody else. Is that narrative still intact, or can you own more now? Is it a different world?
Well, it's definitely a different world. I think that last year, the last couple of years, energy's been a bad word, and there's been a headwind just kind of around the whole space. That headwind's probably turning into a tailwind. Doesn't necessarily mean the commodities improve, but I think sentiment's clearly improving. Not clear to me that money flow toward the energy sector is picking up much. And so I think it's still a very selective market. I kind of think about it as an alpha market, not a beta market right now. And I think it will expand over time, but we've got this OPEC oversupply that we've got to deal with, 3 million barrels a day, and all of this geopolitical uncertainty. So the winds are better. I don't know that it's pulling in investors quite yet.
So Dan, you mentioned natural gas as being one of the potential best outlooks for the energy investments this year. What's the upside case here, the commodity or additional exports?
Yeah, so the exports take a long time to put in place, big multi-billion-dollar projects that take a long time to put in place. And so the export pipeline, if you will, is pretty set from now until the later part of the decade. So the tightness in the market comes from those projects turning on, the fact that we haven't been drilling aggressively for either oil or natural gas. So the supply side's constrained, the demand side's improving. So it feels like price is the reaction function here. So I'd say that it's higher prices, not more exports, at least not in the short run.
Going to oil in the drill, baby, drill scenario, is it possible for President Trump to lower the cost curve enough through deregulation, let's say methane tax, easing of federal land tax, et cetera, to incentivize more drilling even at, say, 70 or 65 oil?
Yeah, the one-word answer there is no. The industry is on a path of capital discipline that says they are not going to spend above their cash flows. In fact, they're returning capital to shareholders aggressively. And so at $70 or $65 a barrel, nobody in the U.S. is drilling more. Alex, what I think that means is we have to look to the geopolitical piece of this. Maybe price comes down or energy in the U.S. gets cheaper because of things that happen in Saudi Arabia, Iran, Russia, not necessarily.
Or the end of like a Ukraine war kind of thing.
Exactly. So there's a big, the U.S. government has more flexibility on energy policy than it's ever had before because we are running at record levels of production. We are a net exporter, not a net importer. And so the actions that happen internationally around oil markets like the Middle East, for instance, we've got more flexibility than we've had in 50 years.
Quickly, just off of that whole conversation about President Trump wanting drill, baby, drill, is that what energy investors want?
No. Drill, baby, drill turned into oversupplied situation, what we call the shale bust that went from 2014 through
Dead,
COVID.
baby, dead.
Yeah,
Right.
exactly. It was quite awful. And so energy investors have pushed aggressively for companies to stop drilling, stop growing, stop oversupplying the market, and instead get more profitable and return those profits to shareholders. So it will take more than a request from the Trump administration for us to see an increase in activity.
All right, Dan, it's really good to see you in person. I'll see you in Houston in a couple weeks.
Sounds great.
All right. Dan Pickering, Chief Investment Officer of Pickering Energy Partners, truly one of the best in the industry in terms of energy trends, sector trends, et cetera. So I'll be catching up with him in Houston for Sarah Week. All right, coming up, Ellen Hazen will be joining us, Chief Market Strategist and Portfolio Manager at FL Putnam Investment Management. Stocks are higher, a bid into the bond market. The dollar drops. How do you manage a potential reciprocal tariff announcement coming at 1 p.m.? This is Bloomberg Intelligence.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Around 1 p.m. Wall Street time, President Trump expected to announce retaliatory tariffs. Of course, we're going to bring that to you live with details. 9 of the 11 major industry groups in the S&P 500, they are higher right now. Consumer discretionary, best performing group. The S&P 500, 37 points higher, up 0.6%. The Dow up 120 points. The Nasdaq 100 up 231 points. I just want to bring you this breaking news. Morgan Stanley looks to boost the size of the latest debt offering from X. 7 Wall Street banks, you'll remember, got stuck with the debt after financing Elon Musk's purchase of the platform, which we knew as Twitter. But it turns out investor demand's been so strong, the bank has told some of them it's going to likely increase the offering. After yesterday's hotter-than-expected inflation report, Edward Cole at Man Group says, you know what, the narrative around the Federal Reserve pretty much has changed.
Yeah, I think the question is not about one cut, no cut. I think the question is really about the extent to which there's a probability of a hike. I think, what we know is that it's policy that kills bull markets.
Well, today we saw that the producer price index rose 0.4% for the month of January. But then you look at some of the components in that report that actually feed into the Fed's preferred inflation gauge. They actually came in better than expected. So that's why yields are lower and stocks are getting a lift. Right now, the 2-year, which is more policy sensitive, that is down 4 basis points, 4.31. The 10-year yield is 8 basis points lower. That's at 4.53. And we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker. That's your Bloomberg Business Flash. Alex and Nora.
Well, thank you so much,
Did
John.
that make any sense?
It made sense to me, and I'm sure to everyone else as well.
I don't know. I wasn't listening, so I'm going to go with
great.
yes.
We can always play it back.
It's like we're married. She doesn't listen.
I'm prepping for a Duke Energy interview, man. I'm sure you were brilliant.
Well, welcome back to Bloomberg Intelligence Radio. I'm Nora Melinda here with Alex Steele. I'm filling in for Paul Sweeney today. We are looking at a market that's in the green, as John was just noting. We have the S&P 500 up 0.6%, and the Nasdaq up over 1%. We've really got the market that's digesting jobs data, also PPI data, but really what we're looking forward to is what will bring more clarity in terms of the tariff conversation. Today, we're joined by Ellen Hazen, Chief Market Strategist and Portfolio Manager at F.L. Putnam Investment Management. She's here to discuss her outlook on the markets today. Ellen, while the tariffs conversation may be an ongoing negotiation tactic for President Trump, it's obviously putting many investors on edge. How are you currently advising your clients in this uncertain climate?
Thanks for having me. I think that the tariffs are a big question mark right now. Our prediction for the year is that expect the unexpected, expect the unpredictable. So we expect that tariffs and some of the other things that the administration is talking about will lead to higher volatility. So what that means is you want to be extra selective, extra careful about finding companies to invest in and areas of the market to invest in that are not going to be overly impacted one way or the other. So go a little bit more toward quality, a little bit more toward safety, and don't take any bets that are too big, because that can come back to bite you when the unexpected happens.
Which is funny because consumer staples are near an all-time high. So it seems like you're not alone in this view. Is that where that safety is?
Actually, I think consumer staples is pretty uninteresting right now. It's very expensive. The growth isn't there. And as you've seen with the inflation numbers, you aren't seeing the staples companies able to pass through that cost inflation that they have had on the input cost side. You saw that with Mondelez. You're seeing that with a lot of staples companies. So I want quality and I want predictability. But in my mind, that does not actually mean consumer staples. It means growth areas where the growth is not going to be subject to cost changes or inflation, where the growth is being driven by underlying forces.
So where is this quality? Where is this safety? Is that in equities, bonds, maybe FX?
So we like equities more than bonds. We think rates are going to stay higher for longer, which makes us cautious on bonds in general. And then in particular, corporate spreads are very tight, as you know. In terms of FX, we still think the dollar will remain strong, so we're sticking with US. And we think that equities are actually the best hedge against inflation. So we would want to stay in US equities, and particularly those that have increasing earnings estimates that are riding growth curves, whether that's artificial intelligence, not just in the chip and hardware space, but also in the software space, whether that's healthcare and new drugs getting approved, whether that's some areas of consumer discretionary. But we want to own companies that are growing, that are seeing their earnings inflect positively.
How do you manage, okay, let me just retract that. What if tariffs kind of go away? As if like we're all prepping to avoid the drama, but if this is just gonna be, some negotiating tactic and the drama is avoided, what then becomes interesting?
I think it's really difficult to make a bet based on tariffs or no tariffs.
Yeah.
I would seek to look for those companies that are going to be somewhat immune to tariffs either way. I don't know that they do go away instantly. I think that this is a tool in the toolkit that the administration is probably going to pull out more than once. So even if they go away in the short term, as they have for Mexico and Canada, they might not go away in the long term. So I think I would have trouble expecting that tariffs are going to be something that's absent for the longer time horizon. If they do go away, I think the obvious areas are things like automobiles and other areas that are imported from China and so forth. But I'm not sure that that's the wisest way to invest at the moment, just because I think this is going to continue to be unpredictable.
Well, there's been lots of different conversations about what could be going on in the government and what changes to expect moving forward. How are you thinking about the potential impact of DOGE and how it may affect different parts of the economy, and of course, how that changes your investment decisions, if at all?
I would love to see a lot more transparency with respect to DOGE so that we understand exactly what's going to happen there. I think the biggest issue or the biggest negative impact of DOGE is going to be if many millions or hundreds of thousands of government employees are let go. That's going to be a significant negative hit to the economy. So I think we want to understand how many people are going to be let go, what areas of the economy those are in, and whether or not that means that the consumer and those households impacted is going to really take a hit.
All right, thanks so much, Ellen. Really appreciate it. Ellen Hazen joining us. She is Chief Market Strategist and Portfolio Manager at FL Putnam Investments. Did you see this this fun one on Reed from the Wall Street Journal?
Tell me more.
Okay, so apparently adults love the kids menu. They want the happy menu for kids. They like the chicken tenders. They like the fries. They don't need all the adult stuff.
Did they say where, or this is just more generally across all restaurants?
Oh, that is a great question. I don't know.
Because I think that I would say I'm one of those, especially if I can place it online, or you don't have to physically see me, and know that I'm an adult. I wouldn't mind a kids menu.
Here's one. This is an industry research firm, Circana, I might be saying that wrong. Probability is high. They say the number of orders for kids' meals placed by adults rose 28% last year compared to 2019. I also wonder how much of that is twofold. One, people eating healthier and say Ozempic, and so you don't have as big an appetite. And then I also wonder how much of it is just financial. Like it's just cheaper to buy a Happy Meal, and if you can make do with 4 nuggets rather than 12, why not do it?
And I guess we also have to wonder how many adults are actually buying it for their kids.
Well, that's
how
true,
can
yes.
you tell me whether or not I'm the one consuming it or I'm getting it for, a child? That's what I tell myself when I order a
Can I get the Pinot Noir juice box?
Maybe so.
Yeah, sure, why not?
With the little game, right? I used to love when they put the toys in there, too.
What was I going to say about that? So it reminds me, my mother has the palate of my 10-year-old.
Okay.
So, like, when I'm gonna make them dinner or like I have to take them out, I'm like, where would my daughter eat? Because that's where my mom wants to eat. And maybe it's just more of that sort of. If it's a bunch of white food, she'll eat it. A little bit of ketchup, and we're all good. All right, coming up, we are going to tackle the IPO market. Sale Point shares are now indicated to open at about $25 each. That's almost 9% higher than its initial public offering price of $23 a share. The company and funds is managed by Thoma Bravo, and they sold about 60 million shares. They increased that price range as well, and the company said it was more than 20 times oversubscribed. We are going to speak to the CEO in just moments and break down the IPO, what's in it for the business, and what they're going to do with all the money that they raised. This is Bloomberg Intelligence on Bloomberg Radio and YouTube. Happy Thursday. Markets a little higher. This is Bloomberg.
listening to Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
Happy Thursday, everybody. I'm Alex Steele alongside Norma Linda. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. We also keep our pulse on the market in all different forms. And today, it is about the IPO market. SailPoint is IPOing today. We're waiting for that first trade. They received orders for more than 20 times shares available. This is according to people familiar with the matter. And they also upped their IPO range as well, raising about $1.38 billion. Shares are looking to open about $25 a share, so higher than that 23. So we're lucky that we have the CEO of SailPoint Technologies with us, Mark McLean. He joins us now. Walk me through. First of all, congrats. IPOs are always a really big day and a ton of work, so nice job getting that over the finish line. What are you going to use the proceeds for? How does it align with SailPoint's growth? Oh, looks like we may have some issues with audio. We will work on getting that back. It'll happen. We love technology.
Right.
But it's interesting. This is sort of a software security firm, right?
Right.
They're enterprise security software company. They're owned by Thoma Bravo, and they raised a good chunk of change in this IPO. I wonder if it's a sector-specific issue or if it's the IPO market is open, we're happy now issue.
Right. I mean, I think that's what the question is for a lot of people, especially as we've been really looking for more IPO activity. I mean, my colleague Bailey Lipschultz actually was the one who wrote this story about SailPoint today, and it's been really interesting, but I think that people are really just trying to keep an eye about like what activity could look like, and it is really interesting to your point about companies coming public. It's really an exciting day for them.
Yeah, but I wonder if it's just, again, like it's a good sector to sort of be in, or if it's a broader market. And I harken back to Venture Global as an LNG exporter, had one of the largest IPOs in energy in years, and it didn't do so well after it IPO'd. It was a tough tape. It was a tough day in an environment that you think would have been really good because it's energy, it's President Trump, it's more LNG exports, and that stock is now trading at about $15. So let's go back now to the CEO of SailPoint Technologies, Mark McClain. We think we have resolved the technical issues. Mark, congrats. IPOs are hard to do. You got it over the finish line. How does this money and the IPO align with your vision of the company?
I'm back. I got it. Oh, wait.
Wait, you got me? Mark?
There we are.
Oh, yay. We love when technology works. It's great to see you. Congrats on the IPO.
Thank you.
How does this IPO mesh with your long-term vision for the company?
Well, I think in general, we've tried to stay focused as a business on building great business with our customers and winning in the market. In some ways, what happens in the financial ownership of the business matters a lot, but it doesn't actually affect our day-to-day lives, if you will, and finding and securing customers and making them successful. That's certainly always our focus. We do think, though, that the IPO gets us back out in the public eye a little more. The importance of what we do and what's called identity security is raising in awareness and importance to the large companies all around the world that we typically serve. And this will help with our visibility. It'll give us future fuel to grow the business. We've had a great run as a private company with Thoma Bravo. Some folks know this. We were public before, and before that we were owned by Thoma Bravo. It's a little bit of an interesting story of a PE-backed IPO, same PE-backed IPO again. But all the while, our focus continues to be on doing great things for our customers and helping them secure their enterprises with identity.
Well, cyber threats have continued to increase. How does SailPoint stay ahead in identity security?
Yeah, what's happened in the world of cybersecurity, there's a lot of shifting things in the landscape. A simple metaphor that sometimes helps folks is that the bad actors or the attackers, not so long ago, their metaphor was to break the glass and grab the jewels and run. Quite often now, and we've seen this in breach reports, they'll try to sneak in the back of the jewelry store, pose as an employee, and eventually try to, quote, clean out the jewelry store. And that's because they've been able to impersonate, so to speak, an employee, and that's a compromised identity. What we do is help businesses, typically mid to large enterprises around the world, focus on understanding all the identities they have, both human and non-human, all the data they care about protecting, and making sure that at any point in time, all of those connections are secure. It's a pretty complex problem at scale.
Who are your competitors right now, and how can you help differentiate?
Yeah, the truth is we've got more, I like to call them PowerPoint competitors than real competitors. I mean, there's folks that are talking about this space quite a bit, but if you look at what happens day to day when we're out in the market, there's very few companies that are capable of delivering the success at scale that we have. We're fortunate to be in almost half of the Fortune 500, about a quarter of the Fortune 2000, and they're generally throwing out older legacy products like from Oracle and IBM. There really hasn't been a strong challenger to us in this key space, and that's part of what I think has gotten investors excited about our potential for long-term durable growth.
So another thing that's been in conversation, I'm curious, how are you all planning to address your debt load?
Well, you know, one of the key use of proceeds will be to pay down a lot of the debt. We actually had a little more debt about 6 months ago. Our backer, Thoma Bravo, chose to take some of that debt out with equity before the IPO, and we'll use the bulk of the proceeds from the IPO to pay that debt down significantly, putting ourselves in what they call a net debt zero, meaning we'll have as much more cash as we have debt, which from a financial profile standpoint makes investors really happy.
Why do you guys decide to do the IPO now? We were just talking about IPOs in general, and I was talking about an LNG exporter that went public at seemingly a great time, and it didn't go so well. So I wonder why strategically you guys chose right now.
Well, we've been watching markets as everyone has, and I think we were really pleased with the progress of the business. We went private about 2.5 years ago. As part of our S1 filing, we talked about the fact that as of our third quarter last year, we'd grown the business at 30%. We'd been able to deliver non-GAAP margins of about 14% and had a strong sense that durable growth would continue. And that was at scale. We're over an $800 million revenue business now. And investors don't see a lot of profiles of growth at scale with profit. And I think our sense was that the markets were kind of hungry, so to speak, for new issuances, particularly I think in technology. Security's been considered a really good market for a long time. I think we looked like a company that would fit many of their requests, so to speak, for a durable growth company in the security space.
How are regulatory shifts driving demand for identity security solutions as enterprises continue shifting to the cloud? How is SailPoint evolving its offerings?
Well, it's interesting you mentioned that. Regulatory is indeed part of the landscape we're addressing. Sometimes, audits or the threat of failed audits or not being able to comply with regulations is a driver. But increasingly, our space is less about that. It hasn't moved away from that, but it's less about that than truly securing their data. Again, what's happened is this concern that data can be compromised through this lens of identity. If a bad actor can somehow get in, break in, steal an identity, or in some way get access to data through those identities, they can do a lot of damage. So that focus on truly protecting the data is really more of an issue today than just regulatory compliance.
Before we let you go, what's it like attracting talent right now in the market?
Well, I tell you, attracting talent is never easy in a very competitive technology market. I think we're very fortunate at SailPoint. One of the things that we pay a lot of attention to is our culture and our values and how that shows up. And as you probably are familiar, Glassdoor runs around and surveys the world and tries to understand how companies are doing. We're super pleased. They released those results recently. We were number 17 in the world, and if you want to cut it by an interesting factor, we were the highest ranked tech company with under 5,000 employees on Glassdoor. I think that speaks a lot about the kind of culture and the values we live out in our company. It attracts and retains very good talent, and we're very fortunate.
Hey, Mark, we appreciate your time today. We look forward to catching up with you again once you've had some time to be public. Mark McClain, CEO of SailPoint Technologies, IPOing today on the NASDAQ. Prices look to indicate to open at around 25. It IPO'd about 23, so we will keep you updated when that stock officially starts trading. I'm Alex Steele alongside Nora Melinda. This is Bloomberg Intelligence Radio. We have another hour lined up for you. We're going to hit all the key major topics plus earnings. We'll talk about trade and also President Trump speaking on reciprocal tariffs coming at 1 p.m. today. The headlines seem to be that they won't go into effect right away. There will be some kind of delay, and markets also reacting to that as well. Plus, we'll talk about earnings. Christopher Ciolino is Bloomberg Intelligence Senior U.S. Machinery Analyst. We'll get the latest issues when it comes to farming equipment from earnings with Deere. Plus, Melissa Brown is Managing Director of Investment Decision Research over at SimCorp. We'll get her take on the market, and we're also paying attention to whatever movement we could see with ending the war in Ukraine. And Oliver Crook is Bloomberg European correspondent. He'll be joining us as well. Jam-packed, lots to talk about. Let's kick it off now with John Tucker with your Bloomberg Business Flash.
And stocks are higher. Treasury yields are lower. And tech is leading the way. NVIDIA, Tesla, Apple, they are the leaders in the S&P 500 right now in terms of index points. Another inflation report today. This is the PPI, hotter than expected. This was on the headline, but dig beneath the surface, the components that actually feed into the Federal Reserve's preferred inflation gauge, they were actually better than forecast. Thus, you get the lower yields. The 2-year, the more policy reactive, down just about 5 basis points. That is at 4.30. The 10-year, 8 basis points lower, 4.53. That is helping to lift stocks right now. The S&P 500 up 36 points, up 0.6%. We're at 6,088. Not that far from a record on an intraday basis. The Dow Jones Industrial Average up 88 points. That's a rise of 0.2%. The Nasdaq 100 up 228 points. That is a 1% pop. Julian Emanuel spoke to him earlier today of Evercore ISI. He says, you know what, the market reaction to yesterday's hotter than expected inflation report, the CPI, that actually gives him confidence the bull market can continue.
It looked like the sky was falling at 8:35, and then basically people started reassessing. And from our point of view, what was interesting is that yesterday, the things that stabilized the market were the things that actually should have been the worst performers.
And right now, on the earnings front, we'll break this down in depth coming up, but Deere is down about 2.2%. Hertz Global says it's finished off selling 30,000 of those electric vehicles it bought. A lot of them were Teslas. The rental giant is trying to move on from an ill-advised bet on plug-in cars. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Nora.
All right. Thanks so much, John Tucker. Appreciate that. Norma Linda sitting in for Paul Sweeney. Nora, what are you guys working on in the equity desk today?
What are we not working on the equities desk today? That's the real
They're this
question.
busy. They don't sleep. They're young. They're running around.
No sleep. But I mean, of course, the conversation has really been about tariffs and how that could impact the market. What sectors are most exposed? Me in the residential or in the real estate space, I'm thinking about how immigration can really affect construction building in the South. Currently working on a story about that. I mean, our eyes are really everywhere. What are we not covering in the market right now, especially in an era where investors across Wall Street are really just grappling with all the uncertainty that's out there?
All right. Well, let's get more on this with another very busy person, Isabel Lee, Bloomberg Cross Asset Reporter. What are you looking at?
Crocs shares are edging higher.
We're back to Crocs again. Okay.
Yes, because demand remains robust. Revenue beat estimates, adjusted EPS beat estimate. Revenue growth for the fiscal year 2025 will grow about 2%. So it just really shows that there is still demand for Crocs. This, though, is helping offset the weakness of its Hey Dude brand, which it just acquired years ago. And Nora and I Googled what Hey Dude is, and we both agreed that it looks comfortable.
Very comfy. I might have to buy some myself.
Really?
No, I mean, around the house. You would never see me outside wearing these.
You're going to Thailand. You're going to load up on really cheap shoes for 2 weeks. So, I mean, who are we kidding here? What else are you looking at?
Robinhood, they're still edging higher by around 12%. And the CEO was actually on Bloomberg TV earlier, and he said it's a very exciting year. It's going to be a, quote, intense year. He also said crypto technology should connect to real-world assets. And as we know, Robinhood reported revenue that more than doubled. So this was boosted by, of course, crypto transactions around the presidential election. And this is the crazy number that I didn't highlight earlier. Revenue grew to $1 billion in the fourth quarter. That beat estimates. But crypto revenue increased by more than 700%.
Wow.
I mean, it's just $358 million. But still, the potential for growth is
huge.
I was going to say limitless, but let's rein it back to huge.
Well, sure. I mean, I just wonder how correlated it's going to be to policy versus risk-on, risk-off trades in the equity market. Anyway, thanks, Isabel. Really appreciate it. Isabel Lee, Bloomberg cross-asset reporter, joining us there. All right, the big event comes at 1 p.m. today. President Trump will be announcing reciprocal tariffs. Reporting seems to be that they won't go into effect right away. There will be a few months delay. Want to get the latest with Enda Curran, Bloomberg Global Economy reporter. Enda, give us your take on the latest.
So it's going to be a big announcement coming, as you say, Alex, 1 p.m. Reciprocal tariffs expected on all trading partners. The thinking is that this is in lieu of the universal tariff that the president has floated before. And the concept behind this is effectively, as President Trump has put it, if they charge us, we will charge them. So that's the headline. New tariffs in the works. What we don't yet know, however, are the specific details of this. When will it be implemented? On which goods? How will it vary by sector? How will it vary by country? What will the time frame of the implementation be? You just mentioned CNBC, for example, making the point they won't be implemented immediately. I think that isn't a surprise, really, given the technical nature of what they're going to try and pull off here. So as I say, it's a big headline, it's a big announcement. It's another step in the new trade policy from the administration, but there's a lot we don't also yet know until those details come out at lunchtime.
So while so many things are still left unclear and a lot of uncertainty abounds, what is the biggest question mark that people really want the answer to concerning this?
I think the question marks are going to be, what level of tariffs are we talking about, and on which kind of goods will those tariffs be imposed on? Because then, by extension, that impacts both how it flows through to the economy here. Are we talking about baskets of typical consumer goods? And does that raise the prospect or potential for at least near-term higher inflation? The second part of it is, what will it mean for businesses, importers and manufacturers in the supply chain if they're facing now higher duties? How will it impact their margins? How will it impact their investment decisions? How will it impact where they source and locate production and investment? So there's lots of question marks there. But of course, remember, the administration makes point that these tariffs are necessary to bring investment back to the US to create manufacturing jobs here. It will also raise revenue for the government. And of course, there are businesses who also complain about unlevel playing fields globally too. So two very different views on this topic.
You have covered also Asia, having lived in Asia for many, many years. You're very in tune with the Chinese economy. And those 10% tariffs on Chinese goods are there, much less than what we saw back in the first Trump administration. In your reporting and you're talking to economists, how is China thinking about this next round?
I think so. Of all the tariff threats that we've had, the tariffs on China are actually in effect. Like you mentioned, Alex, 10% on across the basket of goods coming from China. That has not happened before. It has been up until now quite targeted, but now it's 10% on everything coming in. So that will impact those exporters. It will impact people buying on this side of the chain as well. China, of course, is responding in kind. They're putting some tariffs on US goods in the farming sector, for example, making it awkward for doing business there by putting antitrust investigations on some companies. But to be clear, this 10% level is probably not a game changer when it comes to US-China trade relations. The question is this the start of something much bigger? For example, the president floated much higher tariffs during his campaign, so is this just a starting point, or is it the starting point for a negotiated deal whereby they come to an agreement on the trading of goods or whatever it is, and this more or less settles down? Those are unknowns, but obviously it's coming at a time when the US-Chinese economy is relatively weak. We know it continues to struggle because of that real estate slowdown. Manufacturing sector is going gangbusters, exports going gangbusters, whatever. But as I say, the question mark is this it, or is it just the start of a long process between both?
So you mentioned there's many positives that the government is hoping to come out of this. What is the argument on the other side? Explain what some of the major concerns are.
Well, so when it comes to trade and doing business around the rest of the world, there are certainly companies in the US, specifically in certain sectors, whereby they say they face unfair competition from China, for example, in that China subsidizes certain industries. They can export at cheaper costs. They have cheaper labor, less stringent environmental regulations, and cheaper energy costs and the like. And then that effect is it makes them much more competitive versus US producers, and US producers say that's unfair. We need protection against them. That's the China story. It's not just against China. You'll also hear producers and manufacturers in the US complain about cheaper competitors coming, say, via Mexico as a kind of a backdoor, and from other countries around the world. So there is a lobby group in the US that does push for this. And of course, the administration says it's important to revive the manufacturing industrial base here. But this is where it runs into kind of a fork in the road with economists who say, well, hang on, if you do that, there's going to be a hit to business sentiment, business confidence. Consumers may end up paying higher prices for goods. That's the pushback argument from the economic side. As I say, we're very early stages in this yet, but there are very different views on this, as I said earlier.
Well, thank you so much to Inda Curran for joining us today to really discuss what the impact of tariffs could be and what the questions really are that are lingering out there. We're going to move to a conversation with Christopher Cellino. He's Bloomberg Intelligence Senior U.S. Machinery Analyst, and he's here to talk about Deere earnings. We've got shares of Deere down about 1.7% right now in trading, and this is after a report that it is having some issues with tough farms economics in focus. Christopher, what has really been the broad strokes of what you got and gleaned from this earnings report today?
Yeah, we knew going into the quarter that it was going to be a pretty ugly print, but these results were really, well below even some of the most bearish expectations. The company really continues to underproduce retail demand across the board to bring down some of the excess inventories that the industry has been plagued with. We also, it sounds like some products, there were some timing issues, so products got pushed out till subsequent quarters, which weighed on the 1Q performance. Now, Deere did reaffirm its 2025 net income outlook, and it certainly seems that we are approaching a cyclical trough this year. But just our concern lies that, earnings may not be fully de-risked here. You continue to see further softness on the large ag side. Used equipment inventories remain somewhat of an overhang. Currency headwinds are going to be more pronounced in the back half. And really, we still have this uncertainty around what the U.S. trade policy is going to be and what those retaliatory actions are going to be as well.
Well, I was going to say, they sound relatively confident there'll be a trough, but then you add on tariffs. How well does that confidence hold up?
Yeah, I mean, that's the million-dollar question, right? I mean, I would say that ag historically has had a tremendous amount of pricing power, in Deere in particular. This is a company and a market that even gets positive price in down markets. You know, this quarterly sales were down over 35%, earnings down significantly, and we were still up on pricing. It will add costs, but they have a history and a track record of being able to pass those through.
What has really been the concern for investors out of this report as they're looking forward?
Yeah, I think there's two big concerns here. One is, you know, the expectation is that, yes, 25 is trough and that we should start to see this recovery build into 26. But I still think there's a lot of uncertainty out there as to what the recovery trajectory looks like. Just given the uncertainty around trade and tariffs, you know, I think we're probably looking at a lower for longer type cycle. So maybe we don't get that typical acceleration in the first year after a cyclical trough. So I think investors are still trying to digest that. And then two, you know, the cost side of the equation. It certainly seems that costs are going to go up. How are they going to mitigate that through some of their, you know, internal initiatives or even from shifting some production around with their footprint?
I also am wondering where we are in terms of the cyclicality of equipment. Like, are farmers operating on older stuff that they're going to have to replace, or did they already do that, say, during the pandemic, so they're good for a while, and it's going to take, like, really new high-tech products to get them to fork over that kind of cash?
I think we're good for a little bit of time here. I mean, you have to remember, we had, you know, 3-4 strong years of growth up to the 2023 peak. Yes, 24 was a down year. We were down, you know, 15-16% in terms of units on high horsepower equipment. We're looking at somewhere of a 25 to 30% decline in volumes this year. So that's going to put us, you know, at lows of, you know, over the last 2 decades where we haven't seen before. So from these levels, we think there's probably limited downside risk, but, you know, farmers still have the ability to, you know, push out some of these replacement purchases, at least for another few years, we think.
What do investors really need to see from this company to have a bit of a more positive outlook and to see them actually bypass their competitors?
I think you need to see, you know, inventories, greater confidence that we've, you know, are starting to see some downward movement on inventories. We've seen inventories peak just these past few months. We're just coming down off that peak. So I think we need to see more progress on the inventory reduction front, not only on the new equipment, but used equipment as well. And then certainly, you know, higher crop prices are going to help their customers and ultimately drive equipment purchases. So we've seen a little bit of a rebound in crop prices here over the last 3+ months. I think that has, you know, spurred some optimism in the space that, you know, maybe we do return to a growth in 2026. But I think if we continue to see that progress, that would certainly, you know, bode well for the company.
All right, Chris, really appreciate it. Christopher Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst, joining us on Deere. So here's some breaking news that I'm so well equipped to break for you. The Jets apparently met with Aaron Rodgers last week and informed him they will be moving on without him.
Is that a polite way of saying they fired him?
Well, that's what I kept saying, but the producers were like, no, they're moving on. They're moving on. So, you know.
Moving on,
maybe. Apparently, he was returning from a torn Achilles tendon. He just turned 41 in December. He started in 17 games last season, and they are now moving on from each other. Moving on.
I love it when you do sports. Love it.
Thank you. Why? Because you can mock me more?
No, you do it so well.
But you see, I watched the Super Bowl, so now I know everything there is to know about football.
You watched it for the commercials.
No, I was kind of into it. This is like Paul Reed, you know, watches Landman, and now he's an oil expert. It's like the same thing.
Same thing.
Okay, coming up, we're going to talk more about the markets here and sort of how to position as we head into the volatile reciprocal tariff announcement coming at 1 p.m. The NASDAQ is up by a full 1%. Melissa Brown, Managing Director of Investment Decision Research at SimCorp, will be joining us. Plus, going with geopolitics plus DC, we'll look ahead as to where we are in ending the Ukraine war. We'll head to Europe and discuss that as well. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. It is being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. The offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Since we do it all here, let's bring you this headline. RFK Jr. Looks like he has enough votes to be confirmed as Secretary of Health and Human Services. And we'll bring you more when we get it. Wall Street pushing higher right now. The high for the S&P 500, that was back on, January 23rd, Nora? 61.18, so we're 28 points away.
Okay.
I didn't even need your help. Resorts International.
He just wanted confirmation.
I'm here for support.
He wanted to make sure someone was listening to him.
Yeah, and it's not you. MGM Resorts, best performing stock of the S&P 500, reporting stronger profit for the latest quarter than analysts expected. They cited growth in China. Trends actually looking up for the Las Vegas and North American digital businesses, and those shares right now up a whopping almost 15%. And that report that you referenced earlier, Alex, PPI, inflation at the wholesale level, hotter than economists expected last month. But the part of the report that the Fed actually pays attention to, that was better than expected. Jeff Bezos' space company, Blue Origin, said to cut 10% of its workforce. The space company laid out the personnel shakeup during an all-hands employee meeting. And more space stuff. Talks between South Africa and SpaceX to launch the Starlink internet service, they've stalled. Elon Musk and President Donald Trump ramped up public rhetoric against laws aimed at redressing racial inequality wrought by apartheid in South Africa. That's the reason they cite. Right now, the S&P 500 up 37 points, up 0.6%, 6,089. Dow Jones Industrial Average up 157 points. And the NASDAQ 100 is up 1%, up 214 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. I say apartheid. Everybody says apartheid. Yeah, because I said apartheid once, and this is a true story.
Okay.
The Reverend Desmond Tutu, I was talking to him, asking a question, takes me by the lapels and says, I don't know what is up with you Americans. It's apartheid. Say it with me.
The accent is killing me.
Yeah.
Well, thank you so much, John Tucker, for all the breakdown here. As he mentioned, we have Wall Street. It's really looking past that hot inflation print that we received. We got stocks in the green. S&P 500 up 0.6%. NASDAQ up more than 1%. And bond yields are down. This is all on this idea that maybe the PCE report will come in softer than expected, which we know is the Federal Reserve's main gauge that they look at when we're thinking about inflation. I'm Nora Melinda with Alex Steele here, and I am filling in for Paul Sweeney today. Welcome back to Bloomberg Intelligence Radio. We're going to be chatting a bit more about the markets and all that's going on here. We're joined by Melissa Brown. She's Managing Director of Investment Decision Research at SimCorp. Melissa, how are you advising your clients in terms of limiting their exposure from any fallout that could come from tariff-sensitive sectors?
Well, we think that they need to continue to pay attention to the volatility that's out there. Perhaps being able to mitigate some of the problems that it causes by, buying less volatile stocks, for example, being generally more cautious. There are ways you can avoid inflation-sensitive stocks, and maybe that's, something that people want to look at. But overall, I think the volatility that we've seen recently and are likely to continue to see is going to be important in driving portfolio strategy.
What volatility? Because the VIX is at 15, 16. So what are you talking about?
Well, it's interesting. When you look on an individual stock basis, stock volatilities are up. So if you're going to buy one stock versus another, they are, first of all, probably each more volatile, but less correlated with each other. So what we're seeing is that stocks are not moving together as much as they were, let's say, last year. And So overall, that drives down market volatility, but it doesn't get rid of the individual stock volatility that I think is of more concern to investors.
Well, we had a guest on earlier, and she was talking a bit about the idea of a flight to quality and safety. Is that something that you're also advising your clients about as well? And if so, what areas do I identify as safe during this time period?
Well, we are looking at, so we tend to look at the markets through a lens of style investing. So do you want to buy large cap or small cap, or value or growth, high volatility, low volatility? And so, you know, to be able to, you know, kind of enact more of a flight to quality and remain in equities, we would look to those lower volatility kinds of names, maybe higher dividend yield, maybe cheaper stocks, for example. I think that's, you know, a good way to remain in the market, because the market, you know, continues to move up, but without taking on quite as much risk as maybe you would have last year.
What kind of sector is that? So consumer staples is performing really, really well and is nearing an all-time high. But our last guest said those were boring. So where does that fit in for you?
Well, I would have to say maybe they are boring, but boring is not the worst thing in a market. Well, I would say probably ever, but, you know, certainly in this kind of market where things seem to change on a dime, you know, based on changes in fiscal policy or what the Fed is saying or what the latest inflation report is, maybe boring is a good thing.
So much uncertainty, as we've clearly been discussing. Where are you really thinking about areas that investors should be investing in? Is that equities? Is that bonds? Are we talking FX?
Well, I mean, we're always advocating for well-diversified portfolios, and, you know, making sure that you understand that you actually, you know, you can lower your overall risk by being well-diversified. You know, certainly, you know, U.S. Treasuries have typically been and continue to be, you know, a flight to quality play. But we wouldn't want to only be in Treasuries. We do want to see that diversification by being in U.S. stocks, in non-U.S. stocks, and perhaps, you know, other countries' bonds as well. But again, I think, you know, being well diversified is kind of key these days to not getting hurt too badly by a big move in any one of those asset classes.
All right, we really appreciate all of the insight. Thank you so much, Melissa. Melissa Brown, Managing Director of Investment Decision Research over at SimCorp. Going back to the market here, oil prices turning kind of positive, almost, at least if you're looking at WTI, but prices are still down by over 2.5% over the last 2 days. The potential headline that there might be some advancement into ending the war in Ukraine after President Donald Trump had a phone call with Russian President Vladimir Putin. They will start negotiating to end that war in Ukraine. That's a shift from the previous U.S. policy. Wanted to get some more insight onto this, particularly how Europe fits into all of this. Oliver Crook is a Bloomberg Europe correspondent joining us now. What does Europe understand this plan to actually be?
Listen, I don't think they really know what the plan is actually, what it actually contains. I think what is the dawning realization is that they're not necessarily a protagonist in it, right? And that is kind of the main concern for the Europeans, who are basically being told what is going on by either Pete Hegseth in Brussels, again, or by Donald Trump. And, you know, this is the Munich Security Conference. That's where I am right now. That kicks off tomorrow. This is basically the first high-level interchange between the Trump administration and European leaders of varying sorts. We're going to have J.D. Vance here. We're going to have Marco Rubio. We're going to have Keith Kellogg, the special envoy for Ukraine and Russia. And really, the Europeans are trying to get some insight into what are the actual contents of this plan. And it's the Defense Secretary of the United States that began to give some of the contours. And he basically says that you know, NATO for Ukraine is a no. That's off the table. There's a lot of questions about basically what will the security guarantees be afterwards. Basically, he's looking for European nations to be able to A, pay the bill, but also B, potentially have troops in Ukraine. These are all the sort of questions that they're asking themselves. I think the main concern, though, for the European leaders here is that this is not really a conversation. This is them listening.
I also wanted to just talk about how have our conversations changed with the EU in terms of the U.S. and the EU conversations? How have they changed with this new administration, if at all?
I mean, fundamentally, I mean, whether it's tariffs, whether it's sort of defense. I mean, basically, Trump is basically staying true to everything that he said on the campaign trail. So as much as there is sort of shock and awe by some of these sort of Europeans, at the end of the day, he's doing exactly what he had said, which is basically, yes, they will stay true to NATO, but they want to basically shift the burden away from the United States and onto the Europeans. The problem for the Europeans is that they are just not in a sort of military capacity to take on a lot of these challenges. They've been undershooting the NATO target for many, many years. This was a major issue for the Trump administration the first time he was president, and that really came to roost. And for the Europeans, they're only now hitting their 2% NATO targets. He's demanding now 5% at a moment in time when the European economies are slowing, and basically there's very limited fiscal headroom. He wants them to spend 5% on defense. That's going to be a tall order.
Is there a faction, though, in Europe that would be happy if President Trump was able to do that? I mean, we can't ignore the fact that natural gas prices then would go down, considering the fact that they spiked and Europe was having to sort of siphon off some of its natural gas storage. I mean, that might not be a terrible thing. Also taking a look at some countries that are closer to Russia in terms of still being in NATO. Is there a faction that would like this to happen?
Certainly, there are certainly factions within Europe that would be very happy with this arrangement, basically in all senses. Whether it's Hungary, a number of these countries that basically wanted to see the war to end are very close allies to Donald Trump, and sort of at least in speaking terms with Vladimir Putin. They certainly would like to see that. And listen, I think that there is partially a sort of within Europe more broadly this idea that a new administration who maybe had a more pragmatic approach could sort of precipitate the end of the war and basically acknowledge the facts openly that many of the Europeans really realize, which is that basically NATO for Ukraine is a long shot anyway. There is going to be territory given up by Ukraine basically in any scenario. These are things that no one really wanted to say out loud. The Trump administration is saying out loud, but really what they would like is for that to be said out loud after formal negotiations begin. The fear is for many people that this is putting far too much on the table ahead of the negotiations that you basically will not be able to claw back.
Yeah, and you should definitely check out Oliver Crook's really great Big Take story. You can find that on the Bloomberg terminal or Bloomberg.com/Big Take story, kind of delving into all the different issues and really what's at stake here a few years on in the Ukraine war. Thanks a lot, Oliver Crook, Bloomberg Europe correspondent. It is now official. RFK Jr. has now been confirmed as the new head of the U.S. Department of Health and Human Services. This is launching a new era in U.S. health policy after after he openly questioned the safety of widely used vaccines and promised to remove artificial food dyes from America's food supply. Just to update you, Kennedy was approved largely along party lines of 52 to 48 after some pretty terse confirmation hearings that we saw. All right, coming up on the next segment, we're at Bloomberg Intelligence. Yeah, Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business, will be joining us. He's always outspoken. He always has a take. And I'm wondering what he thinks of this tariff landscape and all the headline risk when, as we talk about, the VIX still stays relatively calm despite a lot of turbulence within individual equities. So we'll get his take on that as tech stocks continue their outperformance today. This is Bloomberg Intelligence. Happy Thursday.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Rally in the mega caps, driving gains in the S&P 500. You have Tesla, NVIDIA, they are up. Apple climbing. The CEO there, Tim Cook, said these are his words now, the newest member of the family is coming on February 19th.
I thought he was getting a dog.
No, I think it's something else. Meta Platforms rising for a 19th straight day, and the U.S. dollar falling. Dollar DXY right now down about 0.5%. This comes after CNBC reporter posted on X that President Trump's new tariffs, which should be announced around 1 o'clock Eastern, will not go into effect until possibly April 1st. The data today, the producer price index rising in January, more than forecast, but several of the components that feed into the Fed's preferred inflation measure, they actually looked good, and that's why Treasury yields, they are lower. The 2-year is down 4 basis points. That's at 431 right now. The 10-year, almost 8 basis points lower. That is at 454. And Rebecca Patterson, the former chief investment officer at Bridgewater Associates, says, you know what, the U.S. is still the place to be for investors.
Despite the valuations and despite the sluggish start to the year, I still think U.S. large caps are where I would prefer to have most of my equity risk.
Right now, the S&P 500, 33 points higher, up about 0.6%. We're at 6,085. The Dow Jones Industrial Average up 135 points. The NASDAQ 100 up 194 points. That is a rise of 0.9%. Jamie Dimon says J.P. Morgan Chase is going to scale back spending on some diversity initiatives that he sees as a waste of money. He was responding to an employee's question about their diversity, equity, inclusion programs. That was during a town hall discussion. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Nora.
All right, thanks so much, John Tucker. Alex Steele here alongside Norma Linda. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. We also love checking in with one of our favorite market commentators, Barry Ritholtz. He's founder of Ritholtz Wealth Management. He also is the host of his podcast, Masters in Business, and he just has really cool takes on everything that's happening in the market. And Barry, your latest commentary is actually on sports betting.
Yeah, and it was based on this fascinating academic study. I'm always looking for ways to convince investors to stop shooting themselves in the foot. And sometimes some of the abstract modern portfolio theory doesn't really resonate. But when we get an academic study that says, hey, despite their history of being terrible bettors continue to actually believe that they're going to catch up, break even, and go ahead, sounds kind of familiar. And what made that so resonant is there was a $1.5 billion bet on the Super Bowl, which is kind of a crazy number, and then the total number of betting that took place on football generally is shocking. And then when you look at how much is, and that was about $35 billion with legal sportsbook. We don't even know what's still happening in the shadows. Overall, sports gambling is now a $150 billion a year industry, and all the same foibles that take place in sports betting happens in investing. It's really quite amazing.
Barry, you mentioned that one of your key takeaways in this piece, you say that sports bettors typically expect to break even on future wagers, even if they've consistently lost money in the past. And it's funny, I was talking to some colleagues recently just about how gambling can really become an addiction. So are you thinking that maybe this is too risky of a trade here?
That's in terms of investing into the legal sports gambling betting companies. Sure. So, casinos. First of all, let's recognize that, like many other industries, legal gambling has figured out, here's the weakness in the human psyche, and here's how we're going to exploit that. I'm not pointing that out like they're unique. Algorithmic social media has done the same thing. Lots of cable news channels are doing the same thing. And when we look at a lot of different sales techniques, it's become a bit of a science. And so when will human nature stop being suckers for things that with a little bit of math you should know better? I'm not willing to bet that industries that rely on that are going to lose anytime soon. Human nature has, at least over the past few million years, been completely unchanging. Maybe one day Elon will implant a chip in our head that will prevent us from making, hey, that's a really terrible bet. Why are you wasting money this way? But until that happens, we're gonna make these bad mistakes. I would rather be the house than bet against the house.
But I love that this column came out today, because this is the day after Robinhood reported earnings, and they did really well. And if you make that correlation, considering they're also trying to get into sports betting, you could make the same argument.
Yeah, so with Robinhood, it's slightly different. It's the same overall approach. Gambling, and I love flying into Vegas and you step off the jetway. You're not even in the airport proper. You're just stepping off the jetway, and there are one-armed bandits there. I'm like, totally. We're not pretending we're anything other than we know the math better than you. Like, here's the way I like to contextualize this. The casinos and all the gamblers in Vegas the casinos are quants, and everybody else is just a dumb day trader. That's really what it feels like. When you look at Robinhood, what they're doing is a little different. It's about gamification. It's about how can we keep people coming back again and again for engagement, for trading. Look, I didn't invent the academic study that says the more active you are, the more tradings you do, the more swings you have, the worse off you are. It's the inverse of what Warren Buffett said. The thing I like about investing is I can stand at the plate and there are no called strikes. I could just wait and wait and wait and wait and swing at my favorite pitch, as opposed to, chasing bad pitches, meaning, all right, that's a half decent trade, let's try it. And most of the time it doesn't really work out. Gamification is the anti-Warren Buffett. Gamification is swing at this pitch, try this, hey, take a look at this. Look, banners and confetti and flashing lights. It's all the things that you aren't supposed to do. I think it was Paul Samuelson who said, investing should be like watching grass grow or watching paint dry. If you want excitement, take $800 and go to Las Vegas and have a good time. But don't gamble in your portfolio. And we're really seeing that overlap where investors are beginning to look more and more like gamblers. And, you want to blame Robinhood, but what's really the underlying cause is just human nature.
Barry, you've got a new book coming out in March about not what to do, but what not to do. Give me the bottom line. It's called How Not to Invest, the ideas, numbers, and behaviors that destroy wealth and how to avoid them.
Right. So I was reluctant to write another finance book because for the past 100 years, there's been thousands and thousands of books, and most of us are still pretty lousy investors. And I kind of channeled Charlie Munger and Charlie Ellis. Charlie Ellis famously wrote that wonderful book, Winning the Losers Games, where he compares investing to tennis. Hey, I play tennis, and 99.9% of people who play tennis or rank amateurs. The way the pros win, they score points. They hit aces, they hit with power, they place the ball on the line, they could drop a ball wherever they want with this great underspin. It doesn't come off. But that's not how the 99% of us win in tennis. We don't actually win in tennis. We tend to lose. We make unforced errors. We double fault. We hit it too long. We hit it wide. We hit it into the net. We hit it with not enough spin, so it comes up into the sweet spot of the other player. And so if you just, in tennis, it turns out, if you just play within yourself and make fewer errors, let the other guy beat themselves,
Very.
well, you tend to win. Same thing in investing.
Very.
Fewer mistakes, better outcomes.
Barry, we're up against a hard break. Gotta go. Barry Ritholtz, Ritholtz Wealth Management. Thank you very much. This is Bloomberg.
This is Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
Happy Thursday, everybody. Alex Steele here alongside Norma Melinda. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. And one of the best when it comes to that networking stuff is Woo Jin Ho. He is a Bloomberg Intelligence Senior Technology Analyst, and he joins us on Cisco. So I was really curious with Cisco, Wooj. Is it that companies are now spending more on tech, not just AI, but everything? Or are they moving spending from AI to the networking stuff that Cisco does? Or is Cisco just doing different things?
Yeah, so Alex, I'm going to start by saying networking is back.
Woo.
Right? So if you think about Cisco, they really haven't been really strong on the AI front, right? Decent revenues, $350 million in AI orders, but it's not going to blow you away like a Dell or an HPE. Much of the beat and the upside was a return to spending on core networking sales, but what was encouraging was that it was the breadth of the beat, and from a segment basis, it was not only networking, it was service providers, data centers, your campus switching, security business, collaboration software. So it was by and large a good quarter for them and good outlook.
So while they may not be the star, as you mentioned, maybe a Dell or something when it comes to AI spending, is it more or less just Wall Street rewarding them for this beat?
Well, part of it is that networking has largely underperformed from a demand perspective or an IT spending perspective for the past year or so. There was some anticipation of the spending recovering, but given that Cisco has been the bellwether in networking, the comps are getting tough, and what we're starting to see is that you're not going to beat big. From a Cisco perspective, the magnitude of beat was bigger than most expected. So this was a good quarter and good outlook.
What is Cisco's proposition when it comes to AI, or is there one?
Well, they actually have a decent proposition. From a base level, foundational level, they actually provide some of the chips from AI. You're really not going to make a lot of money on that because of the lower ASPs, but they provide the optics, also some of the switching gear to come up against smaller players like Arista. But more importantly, and if we start thinking about it from a long-term basis, it's more operational AI, trying to put a lot more smarts into a corporate network, and that's why they acquired Splunk. What Splunk will do for them is to provide some of the software to give you a lot of intelligence that's going on inside the network. So that's a longer-term play, but that hopefully will something that will evolve over the next couple of years.
Well, I'm always thinking also about the government. So Cisco gets the majority of its U.S. government business from the Department of Defense and only about 25% from other agencies. How are you and other analysts thinking about this and what activity could look like moving forward?
Yeah, from a IT spending perspective, I think it's still wait and see. From a Department of Defense perspective, we've got to see if DOGE is going to pare back the Department of Defense, and I will tell you that's probably on the defense side, it's probably going to be very tough to do, quite frankly, especially if you're going to deal with sensitive IT systems. Networking, if you think of it, is the heart of an IT system. If you rip away the heart and can't talk to or provide the communications for everybody else, you're essentially taking down the government. So that's probably one of the last things that the budget cuts will try to touch.
Going back to your original point, which is that networking is back. Why are we so sure that networking is back?
That's a really good question because I've had to fake out a couple times now.
That's right.
So if we think about it, there was a good 6 quarters of underspending, and if I look at the results of some of its peers, Juniper Networks, Extreme, smaller companies, I suspect HPE, that lack of underinvestment is starting to materialize into catch-up spending. That's one. Number two, with these AI systems, you're going to have a lot of data flow that needs to be connected somehow, whether it's on the storage side or on the data center side, and it's going to be very heavily trafficked. So you need much more capacity on the networking side to help support all that data traffic flow.
So, I mean, there really has been a bit of a sales rebound after a sluggish year. Do you think this was just more or less overdue?
Oh, yeah, absolutely. So when we published our 2025 outlook back in November, we highlighted networking as one of the key recovery areas because the recovery has lagged relative to servers and storage. And 2025 was going to be a very big year for networking. And if you look at the stock, since its trough from, I believe, in August, right, it went from like 43 to 66. Investors have picked up on that theme.
All right, we would really appreciate it. Always the best. Woo Jin Ho, Bloomberg Intelligence Senior Technology Analyst, joining us on Cisco. Nora, thanks very much. It was always a pleasure to have you. Thank you for joining.
Love it, love it, love it.
Could not imagine a better 2-hour co-host. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM, channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM, channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. Taking a look at the markets here, you still have tech outperforming, but again, off the highs of the session, slipping a little bit here. The Nasdaq is up only 0.7%. Balance of Power with Joe Matthew is up next after this global news update.
Is confirmed. And with that, Robert F. Kennedy Jr. is the nation's new Health and Human Services Secretary. A notable Senate Republican to vote against him was former GOP leader Mitch McConnell, Democratic leader Chuck Schumer.
If the Senate held a secret ballot today, I'll bet Mr. Kennedy would never come close to becoming confirmed, and that many, if not most, Republicans would vote against him.
CBS's Linda Kenyon.
The vote was mostly along party lines to confirm Kennedy to oversee the nation's health agencies. Kennedy is an environmental lawyer and a vaccine skeptic. His views on abortion also raised concerns during his confirmation process. As health secretary, Kennedy will oversee the nation's 13 separate health agencies with a $1.7 trillion budget.
Now to California, where it's feared a day of heavy rain could mean mudslides. LA Mayor Karen Bass.
Crews are activated to respond to power outages, and LAPD officers are checking on critical infrastructure and are ready to facilitate evacuations.
Ukraine's President Zelensky said today his country will not accept any agreements that come from a planned Trump-Putin talk on the war if Ukraine is not part of that. At NATO headquarters, Defense Secretary Pete Hegseth said the U.S. and its allies have to make NATO great again.
This administration believes in alliances. But make no mistake, President Trump will not allow anyone to turn Uncle Sam into Uncle Sucker.
President Trump says he'll announce reciprocal tariffs today against countries that have taken tariff action against the U.S. In Germany, at least 28 people were injured in an apparent attack in Munich. CBS's Holly Williams at the foreign desk.
A man drove his car into a crowd at about 10:30 this morning local time at a square near downtown Munich. The police say that they have now detained the driver, who they say is believed to be a 24-year-old asylum seeker from Afghanistan.
An Australian hospital is examining patient records after a nurse claimed online to have killed Israelis. 2 nurses have been suspended. New South Wales Minister of Health Ryan Park.
We will not just be looking at this incident, but we will also be obviously going through previous cases to make sure that hospital has been working in a way that reflects those values around safety and care.
The NFL's New York Jets made it official today, telling veteran quarterback Aaron Rodgers they're moving forward without him next season. Checking Wall Street's, right now the Dow is up 97 points, the S&P is up 28, the Nasdaq up 150. This is CBS News. Egg prices are at a record high. We get the story at a farm in Iowa.
Just outside of Des Moines, it's Levon Graffune's 123-year-old farm.
So these are the girls. These are the girls.
On a summer day, they will lay 35 to 40 eggs, but in the winter, the average is about 17.
They just kind of shut down and use a lot of their energy, I think, to keep warm.
How has it been with the egg shortage?
It's been pretty intense. Before this shortage, people just came and got them, but now everybody's like alarmed.
Making their own feed keeps costs down and minimizes outside deliveries, reducing the risk of bird flu spreading to their farm. And these eggs have an additional benefit.
When you get 2 dozen eggs, you know they're fresh.
Lana Zach, CBS News, Ankeny, Iowa.
A measles outbreak in Gaines County, Texas, has sickened more than 20 kids. It has one of the highest vaccine exemption rates in the state. Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Donald Trump says today is the big one. Welcome to the fastest show in politics as the president promises reciprocal tariffs. We don't have them yet, but he has promised a news conference to announce them just as the Prime Minister of India arrives for a state visit. We've got a busy day here with analysis from Jennifer Welch at Bloomberg Economics, the impact these tariffs would have on our trading partners and our own economy. And we'll talk with a major stakeholder this hour. The Premier of Saskatchewan, Canada, is with us in studio following his meetings on the Hill and at the White House. Congress tries to move a budget. RFK Jr. is confirmed as our nation's new health secretary. We'll have analysis from our political panel. Bloomberg Politics contributor Rick Davis today alongside Democratic strategist Janae Wartell. So let's get started, as always, on Wall Street. Helping us with the markets today, Amy Morrison for Charlie Pellet. How's it look, Amy?
All right, thank you, Joe. We did get another read on inflation, and just like the January Consumer Price Index, it came in hot. The Producer Price Index rose by 0.4% in January, down slightly from a sharply revised 0.5% a month earlier, still above the market consensus of a 0.2% rise. Traders looking past all of that, and we check markets for you all day long here at Bloomberg. The S&P 500 up 0.5% or 30 points. NASDAQ up 0.8%. That's about 166 points. The Dow is up 0.25% or 113 points. COMEX gold now 0.5% higher at $29.42 per ounce. Checking oil, WTI down about 0.1%. Brent crude down nearly 0.3%. And the Bloomberg Dollar Spot Index is lower on tariff talk, down about 0.5% as we await news about reciprocal tariffs from the White House. It's coming up about an hour from now. Jeff Bezos' space company Blue Origin is said to cut 10% of its workforce. Sources tell Bloomberg the space company laid out the personnel shakeup during an all-hands employee meeting this morning. The company is looking to cut costs, trim manager ranks, and focus resources on ramping up more rocket launches. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew.
All right, Amy, great to have you on board today on this 13th of February. It's the Thursday edition of Balance of Power. Welcome to Little Friday. I'm Joe Matthew in Washington here on Bloomberg Radio, on the satellite radio and YouTube, where you can find us right now by searching Bloomberg Business News Live. We're going to go through a lot, as always, in the next couple of hours here, including what we expect to be an event at the White House, as Donald Trump says it out loud. Today is the big one. All caps, reciprocal tariffs, triple exclamation point, no further details available. Oh, other than make America great again. Look, he's been talking about this for days. He said it would be Tuesday or Wednesday, right? Yesterday came, he said, I could do it right now or I could wait for tomorrow. And then the truth came, and the guidance from the White House was updated. So what we expect is about an hour from now, Donald Trump in the Oval Office to do something, at least threaten reciprocal tariffs, maybe have a long runway, exact concessions along the way, almost as if you've seen this movie before. By the way, we could be in a world where there are like 3 news conferences today, so we'll be hopscotching through the news together, okay? That's the way it goes now in this new political world that we're in. I'm really happy to say that Jenny is back to help us understand all of this. Jennifer Welch, of course, our chief geoeconomics analyst at Bloomberg Economics, with us again at the table. It's great to see you. So this is like your specialty here, and I really want to hear what you have in mind when we talk about reciprocal tariffs. How many trade partners this could touch, how many countries this could impact. the impact that it might reverberate on our own economy. Let's just start with the idea of reciprocal tariffs and who it might hurt the most.
Yeah, absolutely. So first, there's the question of how are we rating reciprocal tariffs here? Are we literally just looking at tariffs? Are we looking at non-tariff barriers too, like regulations, value-added tax? The answers to those questions will really vastly affect who could be in the bullseye for this. If it's just tariffs, then most likely it's going to be mostly emerging and developing economies.
Okay.
India, Prime Minister Modi is visiting later today, so that timing could be awkward, would be kind of a leading contender there. Argentina, Brazil, Southeast Asia could be on the chopping block, right? If he's also looking at regulations, value-added tax, the EU could really be in the bullseye, and we know how Trump feels about the EU and his concerns about regulations there as well.
And the VAT, right?
Exactly.
So if we're talking about across the board, you know, there's obviously a lot of politics at play here. He says, all right, we're going to come in. One report says April, they take effect, much like we saw with Canada and Mexico. Maybe something comes in return and we have exemptions, or we have this whole idea lifted. I guess the question is, do you see actual reciprocal tariffs ever being implemented?
I think they could be implemented for some partners, right? And I think that's the entire point, is he'll launch this just like steel and aluminum earlier this week, too, where initially he was saying no exemptions. He talked to the Australian PM and said, well, maybe they'll get an exemption because they're buying a lot of our planes, right? So I think there's always kind of room for negotiating and deal making, and that's kind of the point of it, right?
Yes.
I think in terms of the timeline, that's exactly right. The ideal move from his perspective would be enough time for the deal to be made, but enough time pressure that they'll want to come and make a deal.
So this is the playbook then. How many times can you run the same play before it stops working?
Well, we're going to probably test that proposition this year, but the U.S. being the largest economy, most countries are, more heavily reliant on their exports to the U.S. than the U.S. is on exports to them.
Yeah.
So
the answer could be unlimited, by the way. I really don't know the answer to it. We're going to be talking a little bit with the Premier of Saskatchewan, one of 13 premiers from north of the border, to try to talk the administration and others out of this.
Yeah.
How much of that negotiating is taking place behind closed doors?
I think it's constant. And I think in addition to the negotiations with the administration, for example, within the EU, right, they haven't been hit yet, but they're looking at steel and aluminum tariffs. They're looking at the reciprocal tariffs. They know they're looking at Trump's rhetoric towards the EU. They know they might get hit, and they're kind of thinking internally, what are the carrots we could offer? And if those fail, what are our responses? And to your question about how many times can you run this play, I think the concern starts to be from a medium to long-term perspective. Do some of the U.S.'s trade partners start to think about diversifying trade away from the U.S.? Do they start to think about things like the EU's anti-coercion instrument as a response tactic? Some of the same plays that candidly the U.S. has run against China, other countries might now want to run against the U.S.
Wow. Okay. So now we get back to the idea of how this potentially bounces back on the U.S. economy, the extent to which we could hurt ourselves by trying to impact others.
Yeah, exactly. And
have you modeled that at Bloomberg Economics?
That's a really good idea. We should do that.
It's not an assignment. Talk to us broadly, though, about what that would mean.
So I think part of the concern could be, obviously, some economies won't have as much option or leeway to diversify away from the largest economy in the world. But those economies that have the ability to might look at kind of key exports or key vulnerabilities and try and shift those away from too much dependence on the U.S. I think the other thing is they'll look for other pain points that the United States has. Certainly, again, largest economy, we have the most leverage at that kind of high level, but there's a lot of particular pain points where if countries were to hit inputs that we are really reliant on for our own manufacturing, that could cause trouble. If they were to try and, step up, for example, as China has, export controls on critical minerals that we depend on. That's a sort of asymmetric tactic that they could use. And then the third piece is, again, those anti-coercion instruments that allow them to take a pretty broad range of economic measures to defend themselves in response to what they see as U.S. economic coercion.
This is all fascinating. Getting back to the Canada and Mexico threat of tariffs, this is beyond steel and aluminum, that drew thousands of troops to both our northern and southern border, I guess, as a way to hold this off. There's a review that's underway right now. I guess it's a 30-day review, if I remember correctly. What's going into that? What happens at the end of it?
So I think that's a good question of there is sort of the procedure that is supposed to take place with these tariffs, right? Through USTR, that is considering largely the trade issues at play, right? There is also a political process that's taking place across all of these various potential trade wars and threatened trade wars that is more about the additional concessions outside of the trade realm that these partners are offering, like for Canada and Mexico on issues like fentanyl, on immigration. I suppose someday Canada becoming the 51st state, although that seems to have dropped off the negotiating table, thankfully.
Know about that. But they're going to have to come back with some results here. Is that the off-ramp for Donald Trump? You know what? We got troops on the border and stopping fentanyl, and we're going to hold off on these tariffs for now.
I think that, plus, Mexico making pretty, large strides on the immigration front in terms of accepting migrants back, not just from Mexico, but trying to stop other migrants coming back up through Mexico into the United States will be one key area he'll be looking at. The other thing to consider is that the U.S.-Mexico-Canada trade agreement is up for review next year in 2026. Right, yeah. That could be an opportunity for Trump to, try and renegotiate. And I think one of the things he's going to be concerned about, in addition to these other foreign policy issues, is the issue of Chinese investment in Mexico as giving Chinese manufacturers a backdoor into the U.S. market. And that's one he's been pretty consistent on. He wants to close that door.
We heard from Ford this week talking about the devastating impact that these tariffs could have, knowing that these cars are assembled and cross the border multiple times in both directions. Is that impactful for this administration? Does Ford have more influence than, say, a foreign partner asking to hold off on tariffs?
I would think that President Trump, it's always hard to get inside his mind, but I think he is concerned about two things. Certainly the reaction from major U.S. companies, and then second, the reaction from the U.S. stock market. And so I think when those tariffs first hit that Saturday and folks started to realize his campaign threat was becoming reality, there was a little bit of a rejiggering. He was coming out and saying, we're going to wage these trade wars, and the U.S. will feel a little bit of pain, but we need to do it and need to soldier on. But of course, the pain was pretty short-lived because he then pulled it down on Monday.
These companies have to be in touch with the administration, though, right? I mean, you can't make a plan more than a couple of weeks out at the moment if you're in the auto business.
Yeah, absolutely. And not just the auto business, really companies across the map are having to now, so much uncertainty around current trade wars, potential trade wars, tariff levels, et cetera. And I think the reciprocal tariffs, to bring it back to today, is an especially huge area of uncertainty because it's not clear which countries this could apply to. It's not clear what products it could apply to and what the level will be.
We should note as well, the steel and aluminum tariffs ended up being finished products.
Right.
It wasn't just raw materials.
Right.
Those are going into effect, it sounds like, no matter what.
Yeah, I think that's a huge concern for manufacturers and really companies across the spectrum. It'll be interesting to see if we see the White House start to rejigger at least the scope of all these trade wars it wants to launch, given the amount of uncertainty it's introduced into the economy.
Well, based on the inflation data we've seen this week already, you wonder to what extent that is top of mind for them. It's really great to have you back. Jennifer Welch, great to see you, Jenny, and thank you so much for the analysis straight from Bloomberg Economics to your radio and YouTube screen. This is the conversation that we're having today in Washington as we wait to hear from President Trump. And as I mentioned, he does have an event scheduled in the Oval Office. It's not going to be live cameras, but the press pool will be in the room at 1 p.m. when he is expected to hit some executive actions on reciprocal tariffs. We're going to be listening to the language, though, and parsing the words very carefully to see what is actually being implemented or simply being threatened. They're two different things right now, as we just explored with Jenny here on Balance of Power. As we mentioned, the Premier of Saskatchewan is on the way in next. You want to hear directly from a stakeholder who's having these negotiations? Stay with us on the fastest show in politics. This is Bloomberg.
It's 12:21 on Wall Street. I'm Amy Morris. Green across the screen as we await word of reciprocal tariffs from the White House. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.5% or 29 points. NASDAQ up 0.8%. That's about 157 points. And the Dow is up 0.25% or 117 points. The 10-year Treasury yield at 4.53% and the 2-year yield is at 4.3%. Hertz shares fell as much as 14% earlier after the company reported a loss of $2.9 billion in 2024 as Hertz moves on from an ill-advised bet on electric vehicles. Shares of Hertz now 10% lower. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris, and that is a Bloomberg Business Flash. Let's get back to Balance of Power with Joe Matthew.
All right, Amy, thank you so much. Watching Wall Street for us as we talk politics here on Balance of Power. It's great to have you with us on the Thursday edition. Here on Bloomberg Radio, on the satellite radio, and on YouTube, where you can find us right now by searching Bloomberg Business News Live. We're standing by to hear news, at least we're told, on reciprocal tariffs today from the White House. A little more than a half an hour from now, President Trump will be back in the Oval. This is like a daily thing, right? I mean, I don't even need to tell you. They're going to bring the press pool in the Oval Office, and he's going to start talking when he feels like it. That'll be sometime in the next hour. There's an executive action that's supposed to be on the table that will involve reciprocal tariffs. The president talking about it earlier, promising the big one, right? He said, this is the big day. We'll see what that involves. There's the tweet for you if you're with us, or the truth, right? If you're with us on YouTube. 3 great weeks, perhaps the best ever, but today is the big one, he writes, reciprocal tariffs. We'll find out. We don't know. We've heard a lot of tariff threats. Of course, he's already threatened 25% tariffs against Canada and Mexico. Backed away from the line when there were some concessions, as we discussed here, involving troops on the border. He's promised additional tariffs to go into effect soon on steel and aluminum. And here's the news. Our trading partners are not waiting around to find out. Enter the premier of Saskatchewan. I told you he was coming to talk to us here in person. Scott Moe is one of 13 premiers down from our neighbor from the north to make the case for ongoing trade partnerships here in North America. It's great to have you with us at the table. Thank you for making part of part of your day here in Washington.
Thank you for making time.
You're meeting with a lot of stakeholders. You had spoken before you left Canada about meeting with lawmakers, senators, maybe governors, but also, and maybe most importantly, cabinet officials, members of the administration. Was the White House accommodating?
Yeah, no, certainly. And again, from Saskatchewan's perspective, these relationships with policymakers, whether they be in Congress, in the Senate, or part of the administration, we've made it a priority for the last decade and a half to, be in D.C. a number of times throughout the year and to foster these relations because they're important to us. And I think they're important really to what our goal is for Saskatchewan to be part of, creating that continental energy, food, and manufacturing security system.
I want the whole elevator pitch. I want to hear what you're telling people in these meetings. But first, what does the administration want from you? You put 10,000 troops on the border. You've made an agreement to crack down on fentanyl, illegal border crossings. What else would remove this threat from hanging over your head?
Well, I think when it comes to priorities that have been raised by the president, whether it be fentanyl or securing our border, whether it be our 49th parallel or mutually our North American ports, we need to always be looking to do better. And when it comes to fentanyl, that's not a drug at all. It's a poison, and it's killing people north and south of the 49th parallel. And we need to do our level best to eradicate it from our communities and eradicate it from the hands and pockets of friends and all too often family members. And so we're committing to do that in Saskatchewan and pushing our federal government. And our part, the provincial efforts were part of the 10,000 folks on the border, the security officials on the border. And so we're working together, not just because it's a priority of the president, but it's a priority of all of us that live in North America.
I get that, and I also feel like it wouldn't be that hard of a job for you. What I understand was 40-something pounds of fentanyl crossed the northern border last year versus 21,000 through our southern border. You can get your arms around that, can't you?
Yeah, well, all of those pounds are a problem. And so what I would say is when you look at the fentanyl deaths in Saskatchewan communities or Canadian communities, it's very similar per capita to what we're seeing in the U.S. Yeah. And so we need to work together. We need to get that drug out of the hands of anyone that lives in North America.
Your biggest trading partner as a province is the United States.
Sure.
The most important thing you sell the U.S. is crude oil. If these tariffs take effect, if we get into some kind of a trade war, can you replace that business? Can you sell that oil to someone else?
Oh, the crude oil is a little more difficult. We sell crude oil, potash, uranium, agri-food products, and our goal is always to create that continental energy and food security from our province's perspective. Those products will start to flow to other places around the world. But at the end of the day, not only is the United States of America our largest trading partner, North and South, they're our most trusted and important ally as Canadians and as fellow North Americans. And so our goal isn't to sell those products somewhere else. Our goal is to continue with the relationship with the United States because, quite honestly, that oil is coming to U.S. refineries, and it's creating jobs in places like Ohio, Iowa, Illinois, down into Louisiana and Texas. So the trade relationship is strong. We understand there's some discussion about what that's going to look like moving forward, and that's why we're here.
You mentioned potash.
Yeah.
You put out a tweet that got our attention here with a nice shot of a Big Mac on it. You must have gotten Donald Trump's attention with this. From growing wheat, you say, for the bun, to corn for the cattle. It turns out the secret ingredient to the Big Mac is potash. A tariff on Canadian potash is a tax on Americans' food. Is that part of your argument when you sit down in these meetings?
Well, it's a fact.
You know how much he likes a Big Mac. You're not going to raise the price on this, are you?
I think there's about 9. Well, we're not going to. But there's about 9 million tons of potash that come down into the Corn Belt in the U.S. 90% of that comes from Saskatchewan. 35% of the world's potash comes from Saskatchewan. There really is no other market for that product unless you want to start purchasing from Russia.
Yeah.
So, herein lies the importance of the trading relationship we have. We understand, the president is making some efforts to reset trade relationships, and it starts with Canada and Mexico, but likely going to extend beyond that.
So what are you getting in the other direction when you sit down in these meetings? Do you feel good? Were you guys high-fiving leaving the White House?
I don't know for high-fiving, but certainly encouraged. And again, this is building on relationships that are not new for us from Saskatchewan.
Yeah.
We've been down here for 15 years.
So this Rolodex, you're calling the same people you were meeting a couple of months ago.
And more. And we've engaged throughout that decade and a half, and so we feel positive on the relationship. There's going to be some words and some rhetoric back and forth in the meantime, but at the end of the day, we have a goal, and it's to get back to that strong trading relationship, and we feel we can get there.
The words and the rhetoric have been something. The 51st states, Governor Trudeau. Where are we in our relationship culturally? Teach me something about this. You hear the jokes, right? The apartment upstairs above the party, America's hat. What do Americans need to understand about our most important trade partner?
Well, I'd say a couple of things. First is Canada isn't going to be the 51st state. That's some of the rhetoric that we hear back and forth. That being said, Canada and the U.S. are what I think has had and will continue to have post this discussion the strongest economic trading relationship in the world, one that keeps our continent secure. From time to time, the president is raising some topics, whether it be fentanyl, whether it be our military commitments, where Canadians have to have a look in the mirror and make sure that we're doing what we say we were going to do, and make sure that we certainly are contributing as a full partner into that relationship. And so we're doing that. As you see, with 10,000 troops on the border, we're going to secure that border. We're going to make every effort to eradicate fentanyl out of our province. So the discussion will go on, but I think our goals are the same.
It's not only a question about what happens at the end of this 30-day review, however that is going to be rolled out.
Right.
But also a full renegotiation, it seems, of the USMCA. Are these negotiations, these talks happening in tandem?
I wouldn't say they're happening in tandem. We have to make decisions and have discussions as they come. Today, there's no Secretary of Commerce for Canada to actually negotiate with. That's right. So we have some confirmations that have to happen. That being said, we've been able to engage, with folks that I've known for years. Secretary Burgum, for example, former governor of North Dakota, our neighbor to the south, and I've worked closely with then Governor, now Secretary Burgum as well. Secretary Wright, the Secretary of Energy. Important contact for us, and those are contacts that we've had for years and continue to have, and we'll work closely with them as they represent obviously the administration's interest. We'll represent Saskatchewan and Canada's interest, and we'll find our place to that strong trading relationship again.
Does this negotiation of this immediate term 25% tariffs on Canada inform whatever the final product is for USMCA?
Well, I think it informs, where our respective positions are. And, let me say this, and I'll bring us back to the hamburger tweet, or the Big Mac tweet, if you will. Tariffs of any kind are not helpful for that strong, effective, efficient North American trading economy. They aren't helpful for us in providing that continental energy food security that we aspire to. Whether they're tariffs that are put on by President Trump and his administration, whether they're counter tariffs that might be considered by Canada or even by Mexico from that perspective, they're not a positive place for us to be heading. However, they may be used in a short term to enhance a bargaining position or something of that nature. Where we need to be at the conclusion of the conversation is back to a very robust trading environment, providing North Americans, not just Canadians or even just Americans, North Americans, with the security of our continent, the economic security that we aspire to, food, energy security, all of those things. You hear, words like energy dominance.
Yeah, sure.
We can be part of that, and have been, and will be part of that into the future, whether it's electricity generation or oil and gas, which we produce in our area.
I am struck by how similar a lot of the language that you use, a lot of the messaging that you're delivering right now, how similar it is to what we hear from the administration when it comes to energy dominance, when it comes to our military partnership. You're very much on the same page on a lot of these things, aren't you?
Sure. And, sometimes in our families and in our friends groups, we have some discussions on, where everybody's going to, when and where everybody's going to do what. Probably having one of those discussions right now, in fairness. We'll find our way through it. The goals are the same, and I'm quite positive, in particular after the last few days in Washington, D.C., that we will get there, and I just hope it's sooner rather than later.
When are you going to get pipelines for province to province oil and gas?
Herein lies a very significant discussion for Canada moving forward, and we have always been a proponent that those need to be built. And I think, in fairness, by the last number of years, us not being able to, build an east-west pipeline in Canada, we have diminished our economic opportunities as Canadians, and thereby diminished our economic opportunities as well as North Americans. Everything that we do really is in the guise or under the eye of, we're stronger together as nations. We live on the same continent. Geographically, we're the same. Culturally, we're very similar. There are some differences. But when Canada is doing well, U.S. is doing well. When U.S. is doing well, Canada, by extension, will do well as well.
Just might not agree on hockey, no matter what happens with this.
Yeah, well, we're always looking for the Edmonton Oilers to come through, but a few Canadians down in New York playing with the Rangers, young Braden Schneider, he's great. And I can talk about hockey all day, but
We've learned a lot about French-Canadian names. And Joe Mathieu, by the way, if he ever needs to find me in the phone book. Let us know how this goes. In a couple of weeks, could you talk to us when you find out what happens with this review?
I'll come right back here. We're down here in a couple of weeks again.
Okay.
Myself will be back in this market a couple of weeks. I think there's a few premiers here next week as well.
You're one of 13 in Washington now. Is that
13 this week, 2 or 3 coming back next week, and I'll be back the week after.
All right. We'll be watching your Twitter feed as well. We need to get some Big Macs for the control room. Producer James, I'm sure you can work that out for us. 40-piece nugget. We'll share it wide. Thank you so much, Premier. It's great to meet you and appreciate your messaging today here in Washington, D.C. Just a taste of the conversation that we're talking about. A little context you're not going to hear anywhere else as we talk reciprocal tariffs, the threat of additional tariffs coming from President Trump. That'll be about a half an hour from now, as a matter of fact. We'll bring you into the Oval Office when we learn more. I'm Joe Matthew in Washington. We'll assemble our panel next on the fastest show in politics. This is Bloomberg.